This is a very special moment because Chapter 17 is the last chapter of this FIA FA1 book. First of all, congratulations. You have completed 16 chapters out of 17 chapters. That means you have already finished almost the whole journey. You started from the basic foundations of accounting, and step by step you studied business documents, books of prime entry, ledger accounts, sales, purchases, receivables, payables, reconciliations, controls over transactions, and many other important accounting areas. Now we are entering the final chapter. The name of Chapter 17 is Recording Payroll Transactions. Payroll means the wages and salaries paid to employees. In very simple words, payroll is about paying workers for the work they have done. For most businesses, wages and salaries are one of the biggest expenses. A business may pay employees every week, every 2 weeks, or every month. Because payroll involves money, employees, tax, deductions, and legal obligations, it must be recorded very carefully. This chapter teaches us how payroll transactions are calculated, recorded, controlled, and updated in the accounting system. The first topic in this chapter is the nature of payroll. Here, we will learn what payroll means and why it is important. We will understand that payroll is not only a list of employees and payments, it is a major business function. The employer must pay employees correctly and on time. The employer must also deal with taxes, deductions, and records. The second topic is gross pay and basic pay. Basic pay means the normal pay an employee earns for their ordinary working hours. Gross pay means the total pay before deductions. For example, an employee may earn basic pay for normal hours, plus overtime pay, plus bonuses or commissions. When all these amounts are added together before deductions, we call it gross pay. The third topic is overtime, bonus payments, and commissions. Overtime pay is extra pay for working extra hours. A bonus is an extra reward paid to an employee, often because of good performance or business success. Commission is pay based on sales or results. For example, a salesperson may receive commission because they sold a certain amount of goods. This chapter will help us understand how these extra payments affect payroll. The fourth topic is payroll administration and documentation. Payroll administration means the paperwork, records, approvals, and procedures used to manage payroll. A business needs proper documents for payroll, such as timesheets, payroll records, employee details, pay calculations, and approval records. This is important because payroll must be accurate. Employees must be paid correctly, and the business must keep evidence of how the payments were calculated. The fifth topic is payroll deductions. A deduction means an amount taken away from an employee's gross pay. For example, tax may be deducted from an employee's wages. Other deductions may also be taken, depending on the country and the rules. After deductions are taken away from gross pay, the employee receives net pay. Net pay means the amount actually paid to the employee. So the basic idea is this: gross pay minus deductions equals net pay. But remember, in our lessons, we will explain this in words and step by step so it becomes easy. The sixth topic is payment methods. This chapter also explains how employees may be paid. A business may pay employees by cash, check, or automated bank transfer. In modern businesses, automated bank transfer is very common because it is faster, safer, and easier to record. But whichever method is used, the business must make sure the payment is authorized, accurate, and recorded properly. The seventh topic is updating records. After payroll has been calculated and paid, the accounting records must be updated. The business must record payroll costs, deductions, amounts paid to employees, and amounts owed to tax authorities or other organizations. This is important because payroll affects both expenses and liabilities. For example, wages are an expense of the business, but deductions taken from employees may need to be paid later to the government or another organization. Until they are paid, they may be recorded as amounts owed. This chapter also teaches us about the employer's responsibilities. The employer is responsible for paying employees correctly. The employer is also responsible for deducting the correct amounts where required. The employer may need to collect tax from employees' wages and pay it to the government. The employer may also have its own payroll-related costs. So payroll is important not only for employees, but also for the business and the government. Another important part of this chapter is control and security. Payroll information is very sensitive. It may include employee names, pay rates, hours worked, deductions, bank details, and tax information. Because of this, payroll records must be protected. Only authorized people should access payroll information. Payroll payments must also be approved properly to prevent errors, fraud, or unauthorized payments. So, students, the big message of Chapter 17 is this. Payroll is not just paying employees. Payroll is a complete accounting process. It includes calculating pay, recording deductions, preparing payroll entries, paying employees, dealing with employer obligations, protecting payroll information, and updating accounting records. This final chapter is very practical. Every real business with employees must deal with payroll. That is why understanding payroll is an important skill for accounting students. So welcome to Chapter 17, the final chapter of FIA FA1. You have reached the last stage of the book. Stay focused, stay confident, and take this chapter step by step. After this chapter, you will have completed the full FIA FA1 journey. Now we are starting Lesson 1 of Chapter 17. The name of Lesson 1 is The Nature of Payroll. This is the final chapter of the FIA FA1 book, and this chapter is about payroll. Payroll is a very important topic because almost every business with employees must deal with wages and salaries. In simple words, payroll means the system used by a business to calculate and record the money paid to employees. An employee works for the business. The employer pays the employee. The accounting system records the payment. That whole process is part of payroll. For example, imagine a business has 5 employees. 1 employee works as a cashier. 1 employee works as a sales assistant. 1 employee works in the warehouse. 1 employee works in the office. 1 employee works as a manager. At the end of the week or month, the business must calculate how much each employee should be paid. The business must also check whether there are any deductions, such as tax or other required amounts. Then, the business must pay the employees and record everything properly. This is payroll. Now, the textbook explains that the payroll function in an organization is important. The payroll function means the part of the business that deals with employee pay. This function is important for 2 main reasons. First, the employer's obligation to pay wages must be carried out. An obligation means a duty or responsibility. When a business employs workers, the business has a responsibility to pay them correctly and on time. For example, if an employee worked 40 hours in the week, the employer must calculate the correct pay for those hours. If the employee worked overtime, the employer must calculate that correctly as well. Employees depend on their wages and salaries. They use this money for rent, food, transport, family expenses, and other needs. So payroll must be accurate and reliable. Second, the employer's obligations as a tax collector must be carried out efficiently. This means the employer may have to deduct tax or other required amounts from employees' pay and pay those amounts to the government or the correct authority. In many countries, employees do not pay all their employment tax directly by themselves every payday. Instead, the employer deducts the required amount from the employee's pay and sends it to the government. So the employer is not only paying employees. The employer is also helping collect tax through the payroll system. This is why payroll must be controlled carefully. If payroll is wrong, employees may be paid the wrong amount, tax may be calculated incorrectly, and the business may face problems. So students, the nature of payroll is this. Payroll is not just a list of names. Payroll is not just giving money to employees. Payroll is a complete system for calculating employee pay, making deductions, paying employees, recording payroll costs, and meeting legal responsibilities. Lesson 1.1, Payroll and the Employer. Now let's move to Lesson 1.1, Payroll and the Employer. This part looks at payroll from the employer's point of view. From the employer's point of view, wages and salaries are very important because they are often one of the largest expenses of the business. Let us explain this clearly. A business has many expenses. It may pay rent, it may pay electricity, it may buy goods, it may pay insurance, it may pay advertising costs. But for many businesses, one of the biggest costs is paying employees. For example, a supermarket needs cashiers, shelf stockers, cleaners, supervisors, and managers. A restaurant needs cooks, servers, cleaners, and managers. An office needs administrators, accountants, reception staff, and supervisors. All these employees must be paid. So wages and salaries can become a very large part of the total business cost. This is why payroll is very important to the employer. The employer needs a proper payroll system to calculate wages and salaries accurately. The employer also needs payroll information to control costs. For example, if a business pays very high overtime every month, the employer may ask, "Why is overtime so high? Do we need more staff? Are employees working efficiently? Is the rota or schedule planned properly? Are labor costs becoming too expensive?" So payroll information helps management analyze and control business costs. The textbook also says that the payroll function is often part of an organization's system for analyzing and controlling costs and assessing economic efficiency. Let us explain economic efficiency in beginner language. Economic efficiency means using resources wisely and avoiding waste. Employees are an important resource of the business. Their time, effort, and skills cost money. The employer must make sure that the business is getting good value from that cost. For example, imagine a business pays employees $10,000 in wages for 1 week. The employer will want to know whether those employees helped produce enough sales, services, or work to justify that cost. If the business pays a lot in wages but gets very little work or income in return, the business may not be efficient. So payroll helps the employer understand the relationship between labor cost and business performance. Now let us define payroll more directly. A payroll is a list of employees and what they are being paid. For example, a payroll record may show employee name, hours worked, rate of pay, gross pay, deductions, net pay, payment method. But at this stage, the most basic meaning is simple. Payroll is the record of employees and their pay. Now, the textbook says that being on the payroll of an organization means that you are selling your labor to it for an agreed price. Let us explain this carefully. Labor means the work, time, effort, knowledge, and skills of an employee. When a person gets a job, they agree to work for the employer. In return, the employer agrees to pay them. For example, an employee may agree to work for $20 per hour. Another employee may agree to work for $3,000 per month. Another employee may agree to receive a salary of $60,000 per year. This agreed amount is the price of the employee's labor. The employee gives time and skills to the employer. The employer gives pay to the employee. That is the employment relationship. So, if you are on the payroll, it means you are employed by the organization, and the organization has a record of your pay. The textbook also explains that the employee is paid in employment, and the employer benefits from the employee's skills and time. This is very important. The employee benefits because they receive wages or salary. The employer benefits because the employee helps the business operate. For example, a cashier helps the business serve customers. A warehouse worker helps the business move goods. An accountant helps the business record transactions. A manager helps the business organize work and make decisions. Each employee provides value to the business. In return, the business pays the employee through payroll. Now let us use a simple example. Imagine a business called Bright Stationery Store. Bright Stationery Store has 3 employees. Sarah works at the till. Ahmed works in the warehouse. Maria works as the store manager. Sarah earns basic wages for her normal working hours. Ahmed earns wages and sometimes overtime. Maria earns a monthly salary. At the end of the month, Bright Stationery Store must calculate each person's pay. It must record the payroll cost. It must pay the employees. It must also deal with any deductions required by law. From the employer's point of view, this payroll is a major cost. But it is also necessary because without employees, the business cannot operate properly. So payroll is both an expense and an important business function. Now, students, the main message of Lesson 1 and Lesson 1.1 is this. Payroll is the system used to record employees and their pay. The payroll function is important because employees must be paid correctly and on time. The employer may also have responsibilities to deduct tax and pay it to the government. Wages and salaries are often one of the largest expenses of a business. Payroll information helps the employer control costs and assess efficiency. Being on the payroll means the employee works for the organization and is paid for their labor, skills, and time. So, in simple words, payroll connects three important things: the employee who works, the employer who pays, the accounting system that records and controls the payment. That is the foundation of payroll, and we will build the rest of Chapter 17 on this understanding. Now we are studying Lesson 1.2. The name of this lesson is Payroll and the Government. In Lesson 1.1, we looked at payroll from the employer's point of view. We learned that wages and salaries are important because they are often one of the largest expenses of a business. Now, in Lesson 1.2, we look at payroll from the government's point of view. This is very important because payroll is not only about paying employees. Payroll is also connected to tax, government rules, and legal responsibilities. Let us begin with a simple idea. When employees earn money from their work, they may have to pay part of that income to the government. This payment is called tax. Tax is money collected by the government to pay for public services. For example, tax may help pay for hospitals, schools, roads, public safety, social support, and other public services. So, when a person works and earns wages or salary, the government may require that person to pay tax on that income. This is called income tax. Income tax means tax paid on income earned by a person. Now, students, here is the important payroll point. In many countries, the employee does not usually calculate and pay employment tax separately every payday. Instead, the employer deducts the tax from the employee's pay before paying the employee. This means the employer collects tax on behalf of the government. That is why the textbook explains that a payroll officer is, in effect, part of the government's tax collecting system. At first, a payroll officer may think, my job is only to calculate wages and salaries. But actually, the payroll officer also helps collect tax for the government. Let us explain this with a simple example. Imagine an employee earns $1,000 for the month. The employee does not always receive the full $1,000. The employer may have to deduct income tax from that amount. For example, if income tax is $100, the employer deducts $100 from the employee's gross pay. The employee then receives the remaining amount as net pay. The employer later pays the tax amount to the government. So the employer is acting as a collector. The employee earned the money. The government is entitled to receive tax from that money. The employer deducts the tax and sends it to the government. This is why payroll is connected to the government. Now let us understand two important terms. Gross pay means the employee's pay before deductions. Net pay means the amount actually paid to the employee after deductions. For example, if an employee earns $1,000 before deductions, that is gross pay. If the employer deducts tax and other amounts, and the employee receives $800, that $800 is net pay. So payroll must calculate both amounts correctly. It must calculate gross pay, it must calculate deductions, it must calculate net pay. Now, the textbook also mentions national insurance contributions in the United Kingdom. In the United Kingdom, employees may pay national insurance contributions. These are amounts collected through payroll and used for certain state benefits and services. Other countries may have similar systems, but the names may be different. For example, one country may call it Social Security. Another country may call it employment insurance. Another country may call it pension contributions. The exact name depends on the country, but the accounting idea is the same. The employer may deduct certain amounts from employee pay and later pay those amounts to the correct authority. Now, students, do not worry if your country uses different names. For the FA1 exam, the important point is to understand the role of payroll. Payroll is used to calculate wages and salaries. Payroll is used to deduct tax and other required amounts. Payroll is used to pay employees the correct net pay. Payroll is used to record amounts owed to the government or other organizations. Now let us use a simple business example. Imagine a business called Bright Stationery Store. Bright Stationery Store has an employee called Sarah. Sarah earns $2,000 for the month. This is her gross pay before deductions. The payroll officer checks the rules and calculates that $200 must be deducted as income tax. The business may also deduct another amount for a government contribution or state benefit scheme. After all deductions, Sarah receives her net pay, but the deducted amounts do not belong to the business. This is very important. The business cannot keep that money as its own income. The business is holding that money temporarily. Later, the business must pay it to the government or the correct authority. So, from the business point of view, deductions create a responsibility. The business has deducted money from the employee, but it must pass that money on. This is why payroll must be accurate and controlled. If the employer deducts too much, the employee may be underpaid. If the employer deducts too little, the government may not receive the correct amount. If the employer deducts the correct amount but fails to pay it to the government, the business may break the rules. So payroll accuracy is important for employees, employers, and the government. Now let us connect this to accounting records. When payroll is processed, the business records the wages or salaries as an expense, but the business also records deductions separately. Why separately? Because deductions are not the employee's net pay, and they are not business profit. They are amounts that must be paid to another party. For example, income tax deducted from employees is owed to the government. Until it is paid, it is a liability of the business. A liability means an amount the business owes. So payroll affects two things. It affects expenses because wages and salaries are a cost to the business. It affects liabilities because deductions may be owed to the government or other organizations. Now, students, here is the main idea of Lesson 1.2. The government uses employers to help collect tax from employees' earnings. The employer deducts income tax and other required amounts when employees are paid. The employee receives net pay after deductions. The deducted amounts must later be paid to the government or relevant authority. This makes payroll a very important accounting function. In simple words, the employee works and earns pay. The employer calculates the pay. The employer deducts tax and other required amounts. The employee receives net pay. The employer pays the deductions to the government. That is, payroll and the government. The key exam understanding is this. Payroll is not only an internal business matter. It also helps the government collect tax and other contributions. So when you see payroll in the exam, remember that payroll connects three parties: the employee, the employer, the government. The employee earns wages or salary. The employer calculates and pays wages or salary. The government receives tax and other required contributions through the payroll system. That is the foundation of Lesson 1.2. Now we are studying Lesson 1.3. The name of this lesson is Employers' Legal Responsibilities to Collect Income Tax. In the previous lesson, we learned that payroll connects three parties: the employee, the employer, the government. The employee earns wages or salary. The employer calculates and pays the employee. The government may receive income tax and other required contributions through the payroll system. Now, Lesson 1.3 explains the employer's legal duties. Legal duties means responsibilities that the employer must follow because the law requires them. This is very important. Payroll is not just a normal office task. Payroll includes legal responsibilities. If the employer does not follow the rules, the business may face penalties, fines, investigations, or other problems. Let us begin with the basic idea. When employees earn income, tax may need to be deducted from their pay. In many payroll systems, the employer deducts income tax before the employee receives their net pay. This means the employer is acting as a collector for the government. The employer takes the correct tax from employees' pay and later sends it to the tax authority. So the employer has two responsibilities at the same time. The employer must pay employees correctly. The employer must also collect and pay tax correctly. Now let us explain the employer's duties one by one. The first duty is to operate the income tax system for all employees covered by it. This means the employer must apply the correct tax system to the employees who are included under that system. In simple words, if an employee's wages or salary must have income tax deducted, the employer must make sure this happens. For example, imagine Bright Stationery Store has employees who are paid monthly. The payroll officer must calculate their gross pay, calculate the tax deduction, calculate any other required deduction, and then calculate net pay. The employer cannot simply say, the employee can deal with tax by themselves. If the payroll law says the employer must deduct tax, then the employer must do it. The second duty is to maintain the necessary records. Maintain records means keep proper payroll information. The employer must keep records showing how payroll was calculated. These records may include employee names, pay rates, hours worked, gross pay, tax deducted, other deductions, net pay, and payment dates. Why are records important? Because payroll must be provable. If an employee asks why a certain amount was deducted, the employer must be able to explain it. If the tax authority checks the business, the employer must be able to show the records. If there is a mistake, the records help the business find and correct it. For example, if an employee says, "I think too much tax was deducted from my pay," the payroll officer can check the payroll records and see exactly how the amount was calculated. The third duty is to pay the income tax and benefit contributions collected from employees to the tax authorities. This is a very important point. When the employer deducts tax from employees' pay, that money does not belong to the employer. The employer is holding it temporarily. The employer must send it to the government or tax authority. For example, suppose an employee earns $2,000 gross pay and the employer deducts $200 as income tax. That $200 is not business income. The business cannot use it for its own spending. It must be paid to the tax authority. The textbook says that this payment is made every month in most cases. So the employer must not only deduct the tax correctly, the employer must also pay it to the correct authority on time. The fourth duty is to allow the tax office or staff from the benefit contributions office to inspect the records. Inspect means check or examine. The government or relevant authority may want to check whether the employer is following payroll rules correctly. They may check whether the correct tax has been deducted. They may check whether the correct amounts have been paid. They may check whether payroll records are complete and accurate. The employer must allow authorized officers to inspect the payroll records. This is why keeping proper records is so important. If the records are messy, missing, or wrong, the business may not be able to prove that it followed the rules. The fifth duty is to submit end-of-year returns. At the end of the tax year, the employer may have to send a summary report to the tax authority. This report may show information such as total pay, total tax deducted, total contributions, and other payroll details for the year. In simple words, the employer reports what happened during the year. This helps the tax authority check that the correct amounts were deducted and paid. For example, if Bright Stationery Store deducted income tax from employees every month, the end-of-year return summarizes the payroll information for the full year. The sixth duty is to give employees payslips and an annual statement. A payslip is a document given to an employee showing details of their pay. A payslip usually shows gross pay, deductions, and net pay. Gross pay means pay before deductions. Deductions mean amounts taken away, such as tax or other contributions. Net pay means the amount actually paid to the employee. Employees need pay slips because they must be able to see how their pay was calculated. For example, an employee should be able to see how much they earned, how much tax was deducted, and how much they actually received. The employer may also need to give employees an annual statement showing their deductions for the year. This is useful because the employee may need the information for personal tax records, loan applications, financial planning, or checking their own records. The seventh duty is to keep payroll records for at least 3 years after the end of the tax year. This means the employer must not destroy payroll records immediately after paying employees. The records must be kept for a minimum period. The textbook says at least 3 years after the end of the tax year. Why? Because questions, checks, corrections, or investigations may happen later. For example, an employee may ask about a deduction from last year. The tax authority may inspect records from a previous year. The business may need to prove that it paid the correct amount. So payroll records must be stored safely and kept for the required time. Now let us put everything into one simple example. Imagine Bright Stationery Store has an employee called Sarah. Sarah earns monthly pay. At the end of the month, the payroll officer calculates Sarah's gross pay. Then the payroll officer deducts income tax and any required contribution. Sarah receives her net pay. Bright Stationery Store must keep a record of the calculation. It must give Sarah a pay slip. It must pay the deducted tax to the tax authority. It must allow the tax authority to inspect records if required. It must submit end-of-year returns. It must give Sarah an annual statement of deductions. It must keep the payroll records for at least 3 years after the end of the tax year. So you can see, students, payroll is much more than simply paying wages. Payroll includes calculation, deduction, payment, reporting, documentation, and record keeping. Now here is the key exam understanding. The employer has legal responsibility for the payroll tax system. Even though the tax belongs to the employee's income, the employer must operate the deduction system correctly. The employer must deduct the correct amount. The employer must pay the collected amount to the tax authority. The employer must keep proper records. The employer must provide information to employees and tax authorities. The employer must keep records for the required period. So the big message of lesson 1.3 is this. When a business employs people, it also takes on legal payroll responsibilities. The employer must make sure employees are paid correctly. Deductions are calculated correctly. Tax and contributions are paid to the correct authority, and payroll records are properly maintained. In simple words, payroll must be accurate, legal, documented, and controlled. Now we are studying lesson 1.4. The name of this lesson is payroll processing. Payroll processing means the steps a business follows to calculate employee pay, deduct the correct amounts, pay employees, and record payroll information in the accounting system. In simple words, payroll processing is the work done to make sure employees are paid correctly, on time, and safely. This lesson explains the main requirements of a good payroll processing and accounting system. There are 3 very important requirements: accuracy, timeliness, security. Let us explain each one carefully. First, accuracy. Accuracy means the payroll must be correct. This is extremely important because payroll affects employees, the government, and the business. Employees must be paid what they are owed. For example, if an employee worked 40 hours, the payroll system must calculate the correct pay for 40 hours. If the employee worked overtime, the overtime must also be calculated correctly. If the employee earned a bonus or commission, that must also be included correctly. If an employee is underpaid, they may become unhappy, stressed, and lose trust in the business. If an employee is overpaid, the business loses money and may have to recover the overpayment later. So accuracy protects both the employee and the employer. The government must also receive what it is legally entitled to. This means the correct income tax and other required deductions must be calculated and paid to the correct authority. For example, if the employer deducts too little tax, the government does not receive the correct amount. If the employer deducts too much tax, the employee receives less pay than they should. So payroll accuracy is important because the employer is responsible for collecting and paying the correct deductions. The employer's cost information must also be appropriate. Payroll is often one of the largest expenses of a business. Management needs payroll information to understand labor costs and control the business. For example, if a business pays employees $30,000 in 1 month, management may want to know how much was basic pay, how much was overtime, how much was bonus pay, and how much was employer cost. This information helps management make decisions. The textbook gives a very important warning about fraud. Imagine a large organization has 1,000 employees. If someone secretly takes only 10 cents from each employee's pay, that may sound very small for one employee, but 10 cents from 1,000 employees equals $100. If this happens every month, the fraudster could steal $100 each month. Now imagine the organization has 10,000 employees. 10 cents from 10,000 employees equals $1,000. So even a tiny amount from each person can become a large fraud when many employees are involved. This is why payroll must be accurate and carefully controlled. Now let us move to the second requirement, timeliness. Timeliness means payroll must be processed on time. Employees depend on their wages and salaries. They may need their pay for rent, food, transport, bills, family expenses, and other important needs. If employees are paid late, they may suffer stress because they may not have enough cash. So one purpose of payroll processing is to make sure employees do not suffer because of late payment. Timeliness is also important because employee morale may be affected. Morale means how employees feel about their work and employer. If employees are not paid on time, they may lose motivation and trust. They may feel that the employer does not care about them. This can damage the working relationship. Timeliness also matters because the government may require prompt payment of tax and other deductions. For example, if tax deductions must be paid to the tax authority by a certain date, the employer must meet that deadline. If the employer pays late, the business may face penalties or problems with the tax authority. Management information also has deadlines. For example, managers may need payroll information quickly at the end of the month. They may need to know total wages, overtime costs, department costs, and other payroll figures. If the payroll information is late, managers may not be able to make good decisions on time. So timeliness means employees are paid on time, government payments are made on time, and management receives payroll information on time. Now let us move to the third requirement, security. Security means payroll information and payroll payments must be protected. Payroll data is confidential. Confidential means private and sensitive. Payroll records may include employee names, addresses, pay rates, bank details, tax information, hours worked, deductions, and net pay. This information should not be shown to everyone in the business. Only authorized people should see payroll information. Authorized means they have permission and a proper reason to access it. For example, the payroll officer may need to see employee pay details. The accountant may need to review payroll totals. But a normal employee should not be able to see another employee's private payroll information. Security also means cash and checks must not be stolen. In some businesses, employees may be paid by cash or check. If controls are weak, payroll money could be stolen or paid to the wrong person. Even when employees are paid by bank transfer, security is still important. Bank details must be protected. Payment files must be checked. Payments must be approved before they are sent. The payroll system must also be safe from fraud. Fraud means deliberate dishonesty for personal gain. For example, someone might try to add a fake employee to the payroll. A fake employee is sometimes called a ghost employee. This means the person does not really work for the business, but payments are still made in their name. Another fraud risk is changing an employee's pay rate without permission. Another risk is recording false overtime. Another risk is changing bank details so that pay goes to the wrong account. This is why payroll must be secure, authorized, and checked. Now, the textbook also tells us why payroll is an important function. First, employees depend on the timeliness and accuracy of payroll processing. This means employees need to be paid the correct amount and at the correct time. Second, the government has a direct interest in collecting taxes and benefit contributions through the payroll system. This means payroll is not only between the employer and employee. The government is also involved because payroll deductions may need to be paid to the tax authority. Third, wages and salaries are a large component of an entity's total costs. This means payroll is often one of the biggest business expenses. Because payroll is a large cost, it must be recorded accurately and controlled properly. Now let us use a simple example. Imagine Bright Stationery Store has 3 employees. Sarah works at the till. Ahmed works in the warehouse. Maria works as the manager. At the end of the month, the payroll officer calculates their pay. Sarah worked normal hours. Ahmed worked normal hours and some overtime. Maria receives a monthly salary. The payroll officer must calculate each person's gross pay. Then the payroll officer must deduct income tax and any other required amounts. Then the payroll officer must calculate net pay. Then the employees must be paid on time. Then the accounting records must be updated. Now imagine the payroll officer makes a mistake. If Ahmed's overtime is missed, Ahmed is underpaid. If Sarah's tax deduction is calculated incorrectly, the employee or the government may be affected. If Maria's bank details are changed without proper authorization, the payment could go to the wrong account. If the payroll is processed late, all 3 employees may be upset and financially stressed. So this example shows why accuracy, timeliness, and security are all essential. Now, students, the key exam understanding is this. A good payroll system must make sure that employees are paid correctly. It must make sure employees are paid on time. It must make sure deductions are correct. It must make sure the government receives the correct amounts. It must make sure payroll information is private. It must protect the business from errors and fraud. It must provide payroll information when needed. So the big message of Lesson 1.4 is this. Payroll processing must be accurate, timely, and secure. If payroll is inaccurate, employees, the government, and the business can all be affected. If payroll is late, employees may suffer and management may not receive information on time. If payroll is not secure, confidential information may be exposed and payroll fraud may happen. In simple words, payroll processing is not just about paying wages. It is about paying the right people, the right amount, at the right time, with proper records and strong control. Now we are moving to Lesson 2 of Chapter 17. The name of this lesson is Gross Pay and Basic Pay. This lesson is very important because before we can record payroll transactions, we must first understand how an employee's pay is calculated. Let us begin with the most important idea. The amount an employee earns is not always the same as the amount the employee actually receives. This is because deductions may be taken from the employee's pay. So in payroll, we must understand 2 important terms. Gross pay, net pay. Gross pay means the total amount the employee earns before deductions. Net pay means the amount the employee actually receives after deductions. For example, if an employee earns $1,200 before deductions, that is gross pay. If income tax, benefit contributions, and other deductions are taken away, and the employee receives $910, that $910 is net pay. So students, remember this simple sentence. Gross pay minus deductions equals net pay. Now let us explain gross pay more clearly. Gross pay is the pay for the employee's work done in a period. A period may be 1 week, 2 weeks, or 1 month, depending on how the business pays its employees. For example, if employees are paid every month, the payroll department calculates the gross pay for each employee for that month. Gross pay may include different parts. It may include basic pay. It may include overtime. It may include commission. It may include bonuses. It may include back pay. Let us explain each one slowly. Basic pay is the normal pay an employee earns for their ordinary work. For example, an employee may earn $20 per hour for normal working hours, or an employee may earn $3,000 per month as a fixed salary. This normal amount is called basic pay. Basic pay is often the largest part of an employee's earnings. For many employees, most of their pay comes from basic pay. Extra items, such as overtime or bonuses, may be added later, but basic pay is usually the starting point. Overtime means extra pay for working extra hours. For example, an employee may normally work 40 hours in a week. If the employee works 5 extra hours, those extra hours may be paid as overtime. Overtime is added to basic pay when calculating gross pay. Commission means pay based on sales or performance. For example, a salesperson may receive extra money because they sold many products. If a salesperson earns commission of $300, that amount is added to gross pay. A bonus is an extra reward given to an employee. For example, the business may give employees a bonus because the business performed well or because the employee did very good work. A bonus is also added to gross pay. Back pay means pay that relates to an earlier period but is paid now. For example, an employee may have been underpaid last month. If the business corrects this and pays the missing amount this month, that correction is back pay. So students, gross pay is not always just basic pay. Gross pay is the total earnings before deductions. Now let us talk about deductions. A deduction is an amount taken away from gross pay. Common deductions may include income tax, benefit contributions, pension contributions, or other authorized deductions. The employee does not receive the gross pay in full because deductions are taken away first. The amount left after deductions is the net pay. This net pay may be paid to the employee by cash, check, or bank transfer. The textbook explains that a person's wage packet or paycheck is that person's net pay for a period. This means the money the employee actually receives is net pay, not gross pay. Now let us use a simple example. Imagine Sarah works for Bright Stationery Store. Sarah's basic pay for the month is $1,000. Sarah also receives other pay of $200, maybe for overtime or holiday pay. So Sarah's gross pay is $1,200. Now deductions must be taken away. Income tax is $140. Benefit contributions are $100. Other deductions, such as pension contributions, are $50. Total deductions are $290. Now we calculate net pay. Gross pay is $1,200. Total deductions are $290. Net pay is $910. So Sarah earned $1,200, but she actually received $910 into her bank account. This example shows the difference between gross pay and net pay. Gross pay is what the employee earns before deductions. Net pay is what the employee actually receives after deductions. Now, the textbook also explains that there are different ways to calculate employee earnings. One method is paying the same amount every month. For example, a manager may receive a fixed salary of $4,000 per month. This amount may not change much from month to month. Another method is paying an hourly rate. For example, an employee may earn $20 per hour. If they work more hours, they earn more. If they work fewer hours, they earn less. Another method is paying according to performance. For example, an employee may be paid based on how many units they produce or how much they sell. This means the employee's earnings depend on results. Now, students, the key lesson is this. Before we record payroll, we must first calculate gross pay. Then we deduct income tax, benefit contributions, pension contributions, and any other deductions. After that, we find the net pay. The net pay is the amount paid to the employee. So the most important payroll pattern is: start with basic pay. Add overtime, commission, bonuses, and other earnings. This gives gross pay. Then take away deductions. This gives net pay. In the exam, always read carefully whether the question is asking for gross pay or net pay. If the question asks for gross pay, you are looking at the employee's earnings before deductions. If the question asks for net pay, you must take away deductions. So the big message of Lesson 2 is this: basic pay is the normal pay for ordinary work. Gross pay is total earnings before deductions. Deductions are amounts taken away from gross pay. Net pay is the amount actually received by the employee. Payroll begins with understanding these terms clearly. Once you understand gross pay, basic pay, deductions, and net pay, the rest of payroll becomes much easier. Now we are studying Lesson 2.1 only. The name of this lesson is Basic Pay, Fixed Rate per Period. In Lesson 2, we learned that basic pay is the normal pay an employee expects to receive for their normal work. It is the starting point of the payroll calculation. Now, Lesson 2.1 explains one common way of calculating basic pay. This method is called fixed rate per period. Let us break this down slowly. Fixed means the amount is agreed and does not normally change from one pay period to another. Rate means the amount of pay. Period means the length of time the pay relates to, such as 1 week, 1 month, or 1 year. So fixed rate per period means the employee is paid a set amount for a set period of time. For example, an employee may have an employment contract that says they will be paid $9,000 per year. This is called an annual salary. Annual means yearly. So if an employee is paid $9,000 per annum, it means the employee earns $9,000 for 1 year of work. The employee may not receive the whole $9,000 at once. Usually, the yearly salary is divided into equal payments. For example, if the employee is paid monthly, the yearly salary is divided into 12 monthly payments. $9,000 divided by 12 months gives $750 per month. So the employee's basic pay each month is $750. This is the fixed monthly amount before any extra pay or deductions. Now, students, this is important. Basic pay is not the same as net pay. Basic pay is the normal amount earned for the job. Net pay is the amount actually received after deductions. For example, the employee may have monthly basic pay of $750. But after income tax and other deductions, the amount paid into the employee's bank account may be less. So, basic pay is part of gross pay. Gross pay is calculated before deductions. Now let us talk about the employment contract. The employment contract is the agreement between the employer and the employee. It may state the employee's salary, working hours, holiday entitlement, and other conditions. For example, the contract may say the employee will be paid $9,000 per year, will receive 4 weeks of leave, and is expected to work 35 hours per week. This tells us the employee's normal pay and normal working conditions. The fixed salary is usually based on the job itself, not on the number of units produced or the number of sales made. For example, an office assistant may be paid a fixed salary every month. Whether the month is very busy or less busy, the basic monthly salary is still the same, unless there are special adjustments such as unpaid leave, overtime, bonus, or salary increase. This makes fixed rate pay simple and predictable. It is simple for the employer because the payroll department knows the normal amount to pay each period. It is also predictable for the employee because the employee knows how much basic pay to expect. Now let us use a very simple example. Imagine Sarah works for Bright Stationery Store. Her employment contract says she will receive $12,000 per year. Bright Stationery Store pays employees monthly, so the annual salary is divided into 12 equal monthly payments. $12,000 divided by 12 months gives $1,000 per month. Therefore, Sarah's basic pay each month is $1,000. If Sarah receives no overtime, no bonus, and no commission, then her basic pay is also her gross pay before deductions. But if she receives extra pay, such as overtime, then that extra amount is added to her basic pay to find gross pay. For example, Sarah's basic pay may be $1,000, and she may earn $100 overtime. Her gross pay would then be $1,100 before deductions. But the key point in Lesson 2.1 is the basic pay itself. With a fixed rate per period, the employee has an agreed amount for a period of time. Now, let's compare this with other methods briefly, without going into the next lessons. Some employees are paid by the hour. Some employees are paid based on output. Some employees may earn commission or bonuses. But in Lesson 2.1, we are only studying the fixed rate method. This method is common for salaried employees. For example, managers, office workers, administrators, accountants, and supervisors may often receive fixed monthly salaries. Now, students, let us think about why this matters in payroll. At the end of each payroll period, the payroll officer must calculate the employee's pay. If the employee is paid a fixed monthly salary, the payroll officer starts with the fixed basic pay. Then any extra earnings are added. Then deductions are taken away. Then the employee receives net pay. So the payroll process begins with the basic pay. If the basic pay is wrong, the whole payroll calculation may become wrong. For example, if an employee should receive $750 per month, but the payroll officer enters $700, the employee will be underpaid. If the payroll officer enters $800, the employee will be overpaid. So even though fixed rate pay is simple, it must still be recorded accurately. Now here is the main exam understanding. Basic pay is the rate for the job. Fixed rate per period means the employee receives an agreed amount for a specific period. If the salary is annual and employees are paid monthly, divide the annual salary by 12 months. For example, an annual salary of $9,000 gives monthly basic pay of $750. The big message of Lesson 2.1 is this. Fixed rate basic pay is a set amount paid for a normal period of work. It is usually based on the employment contract, and it gives both the employer and the employee a clear and predictable pay amount. Now we are studying Lesson 2.2. This lesson is an example about basic salary. The purpose of this example is to show us how to calculate basic pay when an employee has an annual salary and then the salary changes during the year. This is very important because in payroll, an employee's salary may not stay the same for the whole year. The employee may receive a pay rise from a certain date. So we must calculate pay carefully based on the correct period. Let us understand the situation first. The employee's contract says that the annual salary is $9,000. Annual salary means salary for one full year. The employee joins the business on the 1st of January 20x2. The contract also says that the first 3 months are a probationary period. A probationary period means a trial period at the beginning of employment. During this time, the employer is checking whether the employee is suitable for the job. After this probationary period, from the 1st of April 20x2, the employee's annual salary increases by 10%. Later, on the 20th of May 20x2, the employee is told that everyone in the company will receive another pay rise. For this employee, the extra pay rise is $600 per year. This extra $600 per year is in addition to the 10% pay rise already received. This new increase starts from the 1st of July 20x2. Now students, the key thing is the date. Do not apply all salary increases from January. Each pay rise starts from its own effective date. The 10% increase starts from the 1st of April. The extra $600 per year starts from the 1st of July. Now let us answer the first part. We need to find the basic pay for January 20x2, May 20x2, and July 20x2. For January 20x2, the employee is still on the original annual salary. The original annual salary is $9,000. The employee is paid monthly, so we divide the annual salary by 12 months. $9,000 divided by 12 months equals $750. So the basic pay for January 20x2 is $750. Now let us calculate May 20x2. By May, the first pay rise has already started because the 10% increase began on the 1st of April. So first we calculate 10% of $9,000. 10% of $9,000 is $900. Now we add this to the original salary. $9,000 plus $900 equals $9,900. So the new annual salary from the 1st of April is $9,900. Now we divide this by 12 months. $9,900 divided by 12 months equals $825. So the basic pay for May 20X2 is $825. Now let us calculate July 20X2. By July, the employee has already received the 10% increase, and now the employee also receives the extra $600 per year. The annual salary after the 10% increase was $9,900. Now add the extra $600. $9,900 plus $600 equals $10,500. So the latest annual salary from the 1st of July is $10,500. Now divide this by 12 months. $10,500 divided by 12 months equals $875. So the basic pay for July 20X2 is $875. Now let us answer the second part. The question asks how much basic pay the employee received from the 1st of January 20X2 to the 31st of December 20X2. This means we need to calculate the total basic pay for the whole year. But we must split the year into parts because the salary changed during the year. From January to March, the employee was paid $750 per month. That is 3 months. $750 times 3 months equals $2,250. From April to June, the employee was paid $825 per month. That is also 3 months. $825 times 3 months equals $2,475. From July to December, the employee was paid $875 per month. That is 6 months. $875 times 6 months equals $5,250. Now add the 3 parts together. $2,250 plus $2,475 plus $5,250 equals $9,975. So the total basic pay received from the 1st of January 20X2 to the 31st of December 20X2 is $9,975. Now let us answer the final part. The question asks how much basic pay the employee could expect to receive in the 12 months to the 31st of March 20X3, assuming there are no further pay rises. This period means from the 1st of April 20X2 to the 31st of March 20X3. Again, we must split the period because the salary changed during that time. From April to June 20X2, the employee was paid $825 per month. That is 3 months. $825 times 3 months equals $2,475. From July to December 20X2, the employee was paid $875 per month. That is 6 months. $875 times 6 months equals $5,250. From January to March 20X3, there are no further rises. So the employee continues to receive $875 per month. That is 3 months. $875 times 3 months equals $2,625. Now add these 3 parts together. $2,475 plus $5,250 plus $2,625 equals $10,350. So the basic pay expected for the 12 months to the 31st of March 20X3 is $10,350. Now students, the important exam lesson is this. When salary changes during the year, do not use only one salary figure for the whole year. You must divide the year into time periods. Use the old salary before the pay rise. Use the new salary from the date the pay rise starts. If another pay rise starts later, use the new amount from that later date. Also remember, pay rises are not usually backdated unless the question says they are backdated. In this example, the increases are not backdated, so January, February, and March stay at $750 per month. April, May, and June use $825 per month. July onwards uses $875 per month. The key answers are: January basic pay is $750. May basic pay is $825. July basic pay is $875. Total basic pay for the year to the 31st of December 20x2 is $9,975. Total basic pay for the 12 months to the 31st of March 20x3 is $10,350. So the big message of Lesson 2.2 is this: for a fixed annual salary, first convert the annual salary into monthly pay. Then, when the salary changes, calculate each period separately based on the date the change becomes effective. Now we are studying Lesson 2.3. The name of this lesson is Basic Pay Hourly Rate. In the previous lesson, we learned about fixed rate per period. That means an employee may receive a fixed salary, such as a fixed amount every month. Now we are learning another method of calculating basic pay. This method is called hourly rate. Hourly rate means the employee is paid a set amount for each hour worked. So, instead of saying the employee earns a fixed monthly salary, the business says the employee earns a certain amount per hour. For example, an employee may be paid $5 per hour. If that employee works 40 hours, we calculate the basic pay like this: 40 hours times $5 equals $200. So the employee's basic pay is $200. This is the main idea of hourly pay. The more hours the employee works, the more basic pay they earn. The fewer hours the employee works, the less basic pay they earn. Let us use a very simple example. Imagine Ahmed works at Bright Stationery Store. Ahmed is paid $20 per hour. In 1 week, Ahmed works 35 hours. So Ahmed's basic pay is 35 hours times $20 equals $700. This $700 is Ahmed's basic pay for that week. Now imagine the next week, Ahmed works 30 hours. His basic pay becomes 30 hours times $20 equals $600. So with hourly pay, the pay depends directly on the number of hours worked. This is why businesses must keep accurate records of employee hours. For example, employees may use time cards, clock-in systems, timesheets, or electronic attendance records. If the hours are wrong, the pay will also be wrong. If the business records too many hours, the employee may be overpaid. If the business records too few hours, the employee may be underpaid. So hourly rate pay needs good control and accurate records. Now students, hourly pay is common for workers whose hours may change from week to week. For example, shop assistants, warehouse workers, restaurant workers, factory workers, and part-time employees may be paid by the hour. If they work more hours, they earn more. If they work fewer hours, they earn less. Now, the textbook also explains the idea of high day rate schemes. Let us explain this in simple language. A high day rate scheme means employees are paid a relatively high hourly rate for their normal work. The aim is to encourage greater productivity. Productivity means how much work is produced in a period of time. For example, if a worker produces more output per hour, that worker is more productive. A business may offer a higher hourly rate because it wants workers to work efficiently and produce more. The idea is this: if employees are paid a good hourly rate, they may feel more motivated. They may work more carefully. They may work more efficiently. They may stay with the employer instead of leaving for another job. But from the employer's point of view, the high rate should be worth it. The employer pays more per hour, but hopes the employees produce enough work to justify the cost. Let us use an example. Suppose one business pays workers $15 per hour, and another business pays workers $20 per hour. The business paying $20 per hour may hope that workers are more motivated, more loyal, and more productive. But the business must still check whether the work produced is enough for the cost. So hourly pay is not only about calculating pay. It is also connected to productivity and cost control. Now here is the key exam understanding for Lesson 2.3. Hourly basic pay is calculated by multiplying the number of hours worked by the hourly rate. For example, 40 hours times $5 equals $200. The important things to identify are how many hours were worked, what the hourly rate is. Then multiply them to find basic pay. Lesson 2.4, Piecework. Now we are moving to Lesson 2.4. The name of this lesson is Piecework. Piecework is another method of calculating pay. In piecework, wages are based on the number of units produced. A unit means one item of output. For example, one towel, one box, one chair, one widget, or one product could be one unit. So, instead of paying the employee mainly for hours worked, the business pays the employee based on how many pieces or units they produce. The basic formula is wages equals units produced times rate of pay per unit. Let us explain this with simple words. First, count how many units the employee produced. Second, find the pay rate for each unit. Third, multiply the units produced by the rate per unit. The answer is the employee's wages. For example, suppose an employee is paid $2 for each unit produced. If the employee produces 40 units, the pay is 40 units times $2 equals $80. If the employee produces 50 units, the pay is 50 units times $2 equals $100. If the employee produces 60 units, the pay is 60 units times $2 equals $120. If the employee produces 70 units, the pay is 70 units times $2 equals $140. So students, under piecework, as output increases, wages increase. This method can motivate employees to produce more because the more they produce, the more they earn. Now let us use a simple business example. Imagine Penny works in a small factory making notebooks. She is paid $1 for each notebook she produces. If Penny produces 100 notebooks in a week, her pay is $100. If Penny produces 150 notebooks, her pay is $150. If Penny produces 200 notebooks, her pay is $200. So her pay depends on output, not only on time. This is the basic idea of piecework. Now, why would a business use piecework? A business may use piecework because it wants to encourage employees to produce more. If employees know they will earn more by producing more units, they may work faster and more efficiently. This can be useful in manufacturing, production, assembly work, or any job where output can be measured clearly. But there is also a problem. If employees are paid only by the number of units produced, they may focus too much on speed and not enough on quality. For example, if a worker earns more by producing more chairs, they may rush and produce chairs with defects. So the business must still check quality. Piecework needs control. The business must check how many units were produced. The business must check that the units are acceptable quality. The business must calculate pay correctly. Now, the textbook also explains that pieceworkers are often given a guaranteed minimum wage. A guaranteed minimum wage means the employee will receive at least a certain amount, even if production is low for a reason outside the employee's control. Why is this important? Because sometimes the worker may not produce many units, but it may not be the worker's fault. For example, the machine may break down, materials may not arrive on time, there may be no customer orders. The production line may stop. The worker may be ready to work, but cannot produce because of a business problem. In that case, it may be unfair for the worker to receive very low pay, so the business may guarantee a minimum amount. For example, suppose an employee is paid $2 per unit, but is guaranteed at least $60 per week. If the employee produces 20 units, the piecework pay would be 20 units times $2 equals $40. But because the guaranteed minimum is $60, the employee receives $60. Now suppose the employee produces 40 units. 40 units times $2 equals $80. This is more than the guaranteed minimum, so the employee receives $80. So the rule is simple. Calculate the piecework pay, compare it with the guaranteed minimum, pay the higher amount. Now, students, let us compare hourly rate and piecework. Hourly rate pays the employee for time worked. Piecework pays the employee for units produced. With hourly rate, the important figure is hours. With piecework, the important figure is output. For hourly pay, we ask, how many hours did the employee work? For piecework, we ask, how many units did the employee produce? Now here is the key exam understanding for lesson 2.4. Piecework wages are calculated by multiplying units produced by rate per unit. If there is a guaranteed minimum wage, compare the calculated piecework wage with the guaranteed minimum wage. The employee receives the higher amount. So the big message of lessons 2.3 and 2.4 is this. Hourly rate pay is based on time worked. Piecework pay is based on output produced. Both methods are used to calculate basic pay, but they use different measures. Hourly rate uses hours. Piecework uses units. Now we are studying lesson 2.5. This lesson gives us an example of piecework. In the previous lesson, we learned that piecework means the employee is paid based on the number of units produced. The basic idea is wages equals units produced times rate of pay per unit. But this example adds one more important point. Sometimes the employee is also guaranteed a minimum wage. A guaranteed minimum wage means the employee will receive at least a certain amount, even if their piecework earnings are lower. This protects the employee when output is low. Now let us look at the example. Penny Pincher is paid 50 cents for each towel she weaves. This means every towel gives her 50 cents of pay. She is also guaranteed a minimum wage of $60 for a 40-hour week. This means that if her piecework pay is less than $60, she will still receive $60. So the rule is simple. First, calculate the piecework pay. Then compare it with the guaranteed minimum wage. The employee receives the higher amount. Now Penny produces different numbers of towels over 4 weeks. In week 1, she produces 100 towels. In week 2, she produces 120 towels. In week 3, she produces 140 towels. In week 4, she produces 160 towels. Now let us calculate each week slowly. In week 1, Penny produces 100 towels. She earns 50 cents for each towel. 100 towels times 50 cents equals $50. But Penny is guaranteed a minimum wage of $60. $50 is less than $60, so Penny receives $60 in week 1. This is because the guaranteed minimum protects her from receiving only $50. In week 2, Penny produces 120 towels. 120 towels times 50 cents equals $60. This is exactly the same as the guaranteed minimum wage. So Penny receives $60 in week 2. There is no extra pay yet because her piecework earnings are only equal to the guaranteed minimum. In week 3, Penny produces 140 towels. 140 towels times 50 cents equals $70. $70 is more than the guaranteed minimum wage. So Penny receives $70 in week 3. Now the piecework system gives her extra benefit because she produced more than the minimum level needed. In week 4, Penny produces 160 towels. 160 towels times 50 cents equals $80. $80 is more than the guaranteed minimum wage. So Penny receives $80 in week 4. Now, let us understand the important lesson behind this example. Penny is guaranteed $60. She is paid 50 cents per towel. To earn $60 at 50 cents per towel, she must produce 120 towels. So if she produces fewer than 120 towels, her calculated piecework pay is below $60, but she still receives the guaranteed minimum of $60. If she produces exactly 120 towels, she receives $60. If she produces more than 120 towels, then she starts earning more than the guaranteed minimum. This means Penny has no extra financial incentive to produce more unless she produces more than 120 towels. For example, if she produces 100 towels, she receives $60. If she produces 120 towels, she also receives $60. So the increase from 100 towels to 120 towels does not increase her pay. But if she produces 140 towels, her pay becomes $70. If she produces 160 towels, her pay becomes $80. So the incentive begins after 120 towels. This is why the textbook explains that the guaranteed minimum wage may change the motivation of a pieceworker. It protects the employee, but it may also reduce the incentive to produce more until the employee passes the minimum wage level. Now, students, the exam technique for this type of question is very simple. Do not immediately use the piecework answer as the final pay. First, calculate the piecework pay. Second, compare it with the guaranteed minimum wage. Third, choose the higher amount. For this example, the weekly pay is week 1, $60, week 2, $60, week 3, $70, week 4, $80. So the key message of lesson 2.5 is this. When piecework has a guaranteed minimum wage, the employee receives either the calculated piecework pay or the guaranteed minimum wage, whichever is higher. Lesson 2.6. Example, piecework hours. Now we move to lesson 2.6. This is another piecework example, but it uses piecework hours. This is a little different from the first piecework example, so let us go slowly. In some businesses, employees may produce different types of products. Some products may be quick and easy to make. Other products may take longer. If the business paid only by the number of units, it might be unfair. For example, producing one small simple item is not the same as producing one large difficult item. So instead of paying directly per unit, the business may give each product a standard time allowance. A standard time allowance means the normal amount of time allowed for making 1 unit of that product. This allowed time is used to calculate piecework hours. Piecework hours are not always the actual hours worked. Piecework hours are the allowed hours earned based on output. Now let us look at the example. The employee is paid $3 per piecework hour produced. In a 40-hour week, the employee produces 2 products. The employee produces 15 units of product X. The time allowance for product X is 0.5 hours per unit. The employee also produces 20 units of product Y. The time allowance for product Y is 2.0 hours per unit. Now we must calculate the total piecework hours. First, calculate the piecework hours for product X. The employee produced 15 units of product X. Each unit of product X is allowed 0.5 hours. So 15 units times 0.5 hours equals 7.5 piecework hours. This means product X gives the employee 7.5 allowed hours. Now calculate the piecework hours for product Y. The employee produced 20 units of product Y. Each unit of product Y is allowed 2.0 hours. So 20 units times 2.0 hours equals 40.0 piecework hours. This means product Y gives the employee 40 piecework hours. Now add the piecework hours together. 7.5 piecework hours plus 40.0 piecework hours equals 47.5 piecework hours. So the employee has produced 47.5 piecework hours. Now the employee is paid $3 for each piecework hour. So 47.5 piecework hours times $3 equals $142.50. Therefore, the employee's pay for the week is $142.50. Now, students, let us understand the important point. The employee worked in a 40-hour week, but the employee produced 47.5 piecework hours. This means the employee produced output that, according to the standard allowances, represents 47.5 hours of work. So the employee is paid based on the allowed piecework hours, not simply the actual 40 hours worked. This can reward efficiency. For example, if an employee works 40 actual hours but produces output equal to 47.5 allowed hours, the employee earns pay for 47.5 piecework hours. That encourages employees to produce more efficiently. Now let us connect this to the earlier piecework lesson. In simple piecework, pay is based on units produced. For example, towels produced times rate per towel. In piecework hours, pay is based on allowed hours produced. For example, units produced times allowed hours per unit. Then total allowed hours times pay rate per piecework hour. So the calculation has two stages. First, calculate the piecework hours for each product. Second, multiply the total piecework hours by the rate per piecework hour. Now, students, here is the exam technique. When a question gives different products and different time allowances, do not add the units directly. Why? Because one unit of product X may not take the same time as one unit of product Y. Instead, calculate the allowed hours for each product separately. Then add the allowed hours. Then multiply by the pay rate per piecework hour. For lesson 2.6, the answer is product X gives 7.5 piecework hours. Product Y gives 40 piecework hours. Total piecework hours are 47.5 hours. Pay is $142.50. So the big message of lessons 2.5 and 2.6 is this. Piecework can be calculated in different ways. Sometimes we calculate pay directly from units produced. Sometimes we compare piecework pay with a guaranteed minimum wage. Sometimes we calculate piecework hours first, especially when different products take different amounts of time. But the main idea is always the same. Piecework rewards output. The more valuable output the employee produces, the more pay the employee can earn. Now we are moving to lesson 3 of chapter 17. The name of this lesson is Overtime, Bonus Payments, and Commissions. In the previous lessons, we learned about basic pay, gross pay, hourly rate, and piecework. Now we're going to learn about extra payments that may be added to an employee's pay. Remember, an employee's pay is not always only basic pay. Sometimes an employee may receive extra pay because they worked extra hours. Sometimes an employee may receive extra pay because they achieved a target. Sometimes an employee may receive extra pay because they made sales for the business. These extra payments are very common in payroll. The three main extra payments in this lesson are overtime, bonus payments, and commissions. Let us understand each one clearly. Overtime means extra hours worked above the normal working hours. For example, suppose an employee's normal working week is 40 hours. If the employee works 45 hours, the extra 5 hours are overtime hours. The employee may receive extra pay for those overtime hours. Overtime is very common in businesses where work is busy during certain times. For example, a shop may need employees to work extra hours during holiday periods. A factory may need employees to work extra hours when there are many customer orders. An office may need employees to work extra hours before an important deadline. So overtime happens when the employee works more than the normal required hours. Now let us talk about commission. Commission is often paid to employees who make sales. It is usually calculated as a percentage of the value of the sale. In simple words, the more the employee sells, the more commission the employee may earn. For example, imagine a salesperson sells goods worth $10,000. If the commission rate is 5%, the employee earns commission based on that sale value. Commission is common in sales jobs because it encourages employees to sell more. For example, a car salesperson, real estate salesperson, insurance salesperson, or retail salesperson may receive commission. The business uses commission to motivate employees to increase sales. Now let us talk about bonuses. A bonus is an extra payment made to an employee as a reward. A bonus may be paid when an agreed target is reached. For example, if a sales team reaches its monthly sales target, the business may pay a bonus. A bonus may also be paid because management decides to reward employees. For example, if the business had a very successful year, management may decide to pay employees a year-end bonus. Bonuses can take many forms. They may be paid to one employee, they may be paid to a team, they may be paid to all employees. They may be based on profit, productivity, attendance, performance, or management decision. So, students, the main idea of lesson 3 is this. Basic pay is the normal pay for normal work. Overtime, bonuses, and commissions are extra payments that may increase the employee's gross pay. Remember, gross pay means total pay before deductions. So if an employee earns basic pay plus overtime plus bonus plus commission, all of these amounts are added together to calculate gross pay. Lesson 3.1, Overtime. Now let us focus on overtime. Overtime pay is payment for work done in excess of an employee's normal hours at basic rate pay. Let us explain this slowly. Every employee may have normal working hours. For example, an employee may be expected to work 35 hours per week or 40 hours per week. These normal hours are paid at the basic rate. The basic rate is the normal pay rate for the job. For example, if an employee earns $4 per hour for normal working hours, that $4 per hour is the basic rate. Now, if the employee works more than the normal hours, those extra hours may be treated as overtime. Overtime is often paid at a higher rate than the basic rate. Why? Because the employee is giving extra time beyond the normal working hours. The business may pay a higher rate to reward the employee for working extra hours. For example, an employee may earn $4 per hour for normal hours, but for overtime hours, the employee may earn $6 per hour. This is called time and a half. Time and a half means the employee is paid the normal hourly rate plus half of the normal hourly rate again. Let us make that very clear. If the basic rate is $4 per hour, half of $4 is $2. So time and a half is $4 plus $2. That gives $6 per hour. So if the employee works overtime at time and a half, the overtime rate is $6 per hour. Now let us use a simple example. Imagine Ahmed works for Bright Stationery Store. His normal working hours are 40 hours per week. His basic hourly rate is $10 per hour. If Ahmed works only 40 hours, all 40 hours are paid at the basic rate. But if Ahmed works 44 hours, the extra 4 hours are overtime. The first 40 hours are normal basic pay. The extra 4 hours are overtime pay. If the overtime rate is time and a half, Ahmed will receive a higher rate for those 4 overtime hours. This means overtime increases the employee's gross pay. Now, students, the overtime rate can be decided in different ways. Sometimes the overtime rate is based on the employee's hourly rate. Sometimes it is fixed by agreement between the employer and the employee. Sometimes it is written in the employment contract. The employment contract may say that overtime will be paid at time and a half. It may say that overtime will be paid at double time. It may say that certain overtime hours have one rate and later overtime hours have another rate. Double time means the employee is paid twice the normal hourly rate. For example, if the basic hourly rate is $4 per hour, double time is $8 per hour. Now let us explain the textbook idea. A contract may say that the employee works 40 hours at the basic rate. Then the first 10 hours of overtime are paid at time and a half. After those 10 overtime hours, any further overtime is paid at double time. Let us make this simple. Suppose the basic rate is $4 per hour. The normal 40 hours are paid at $4 per hour. The first 10 overtime hours are paid at $6 per hour because time and a half of $4 is $6. Any overtime above those 10 hours is paid at $8 per hour because double time of $4 is $8. This means payroll must be careful. The payroll officer cannot just multiply all hours by the same rate when different rates apply. The payroll officer must separate the hours. Normal hours are paid at the basic rate. First level overtime is paid at the first overtime rate. Second level overtime is paid at the higher overtime rate. This is why overtime calculations need accurate records of hours worked. The business must know how many normal hours the employee worked. It must know how many overtime hours the employee worked. It must know which overtime rate applies. Now, students, here is the key exam understanding. Overtime is extra work above normal working hours. Overtime is often paid at a higher rate than normal pay. Time and a half means the basic rate plus half of the basic rate. Double time means twice the basic rate. Overtime increases gross pay because it is added before deductions. So the big message of Lesson 3 and Lesson 3.1 is this. Employees may receive more than basic pay. They may receive overtime for extra hours, commission for sales, and bonuses for targets or rewards. Overtime is especially important because it must be calculated using the correct number of hours and the correct overtime rate. Now we are studying Lesson 3.1.1. This lesson gives us an example of overtime. The purpose of this example is to show how to calculate pay when an employee works normal hours and also overtime hours at different overtime rates. Let us read the situation carefully. Marguerite Yourcenar works in a library. She is paid on an hourly basis. This means her pay depends on how many hours she works and what rate applies to those hours. Her basic rate for the 35 hours she normally works each week is $6 per hour. So the first 35 hours are normal working hours. These normal hours are paid at the basic rate. The basic rate is $6 per hour. Now, the question tells us about overtime. The first 5 hours of overtime are paid at time and a quarter. Any more overtime hours are paid at time and a half. In the week ended 3rd August 20x2, she worked a total of 47 hours. We need to calculate her basic pay and her overtime payments, showing how each amount is made up. Now, students, the first thing we must do is separate the total hours. She worked 47 hours in total. Her normal working hours are 35 hours. So the overtime hours are 47 hours minus 35 hours. That gives 12 overtime hours. So out of the 47 hours, 35 hours are basic hours. 12 hours are overtime hours. But we cannot calculate all 12 overtime hours at the same rate because the question gives 2 overtime rates. The first 5 overtime hours are paid at time and a quarter. The remaining overtime hours are paid at time and a half. So we split the 12 overtime hours into 2 parts. First 5 overtime hours at time and a quarter. Remaining 7 overtime hours at time and a half. Why 7 remaining hours? Because total overtime is 12 hours. The first 5 overtime hours use the first overtime rate. 12 hours minus 5 hours gives 7 hours. So 7 overtime hours use the second overtime rate. Now let us calculate the basic pay first. The basic pay is for the normal 35 hours. The rate is $6 per hour. So 35 hours times $6 gives $210. Therefore, the basic pay is $210. Now let us calculate the first overtime payment. The first 5 overtime hours are paid at time and a quarter. Time and a quarter means the employee receives the basic rate plus 1/4 of the basic rate. The basic rate is $6 per hour. 1/4 of $6 is $1.50. So time and a quarter is $6 plus $1.50. That gives $7.50 per hour. Now calculate the pay for the first 5 overtime hours. 5 hours times $7.50 gives $37.50. So the first overtime payment is $37.50. Now let us calculate the second overtime payment. The remaining 7 overtime hours are paid at time and a half. Time and a half means the employee receives the basic rate plus half of the basic rate. The basic rate is $6 per hour. Half of $6 is $3. So time and a half is $6 plus $3. That gives $9 per hour. Now calculate the pay for the 7 remaining overtime hours. 7 hours times $9 gives $63. So the second overtime payment is $63. Now we add all the parts together. Basic pay is $210. First overtime payment is $37.50. Second overtime payment is $63. Total pay is $210 plus $37.50 plus $63. That gives $310.50. So Marguerite's total pay for the week is $310.50. Now let us review the full answer clearly. 35 basic hours at $6 per hour gives $210. 5 overtime hours at $7.50 per hour gives $37.50. 7 overtime hours at $9 per hour gives $63. Total hours are 47 hours. Total pay is $310.50. Now, students, the exam technique is very important here. When a question gives more than one overtime rate, do not calculate all overtime hours at one rate. First, find total hours worked. Second, subtract normal hours to find overtime hours. Third, split the overtime hours according to the rules in the question. Fourth, calculate each part separately. Fifth, add all the parts together. In this example, the mistake many students may make is to calculate all 12 overtime hours at time and a half. That would be wrong, because the first 5 overtime hours must be paid at time and a quarter. So always read the overtime rule carefully. The big lesson is this: overtime calculations must be separated into normal hours and overtime hours. If there are different overtime rates, each group of overtime hours must be calculated using the correct rate. Now we are studying lesson 3.2. The name of this lesson is bonuses. In the previous lesson, we learned about overtime. Overtime is extra pay for extra hours worked above normal working hours. Now we are learning about another type of extra payment. This extra payment is called a bonus. A bonus is an extra payment made to an employee or to a group of employees as a reward for results achieved. In simple words, a bonus is additional pay given because the employee or the team has done something well. For example, an employee may receive a bonus because they reached a sales target. A team may receive a bonus because they completed work faster than expected. Factory workers may receive a bonus because they produced more units than the target. A whole department may receive a bonus because their performance was very good. So, a bonus is not normally the basic pay of the employee. It is extra pay added to the employee's earnings. Now let us understand why businesses pay bonuses. The main purpose of a bonus is motivation. Motivation means encouraging employees to work harder, perform better, and reach targets. A business may say to employees, "If you reach this target, you will receive an extra payment." This can encourage employees to improve their performance. For example, imagine a sales department has a monthly sales target of $50,000. Management may say, "If the sales team sells more than $50,000 this month, each salesperson will receive a bonus." Now the employees have an extra reason to work harder. They may speak to more customers, follow up with clients, improve their sales effort, and try to exceed the target. If the target is achieved, the bonus is paid. Now let us use a simple example. Imagine Bright Stationery Store has a sales team. The monthly sales target is $20,000. At the end of the month, the sales team achieves $25,000 in sales. Because the team exceeded the target, management decides to pay a bonus to the sales employees. This bonus is extra pay. It is added to their gross pay before deductions. Remember, gross pay means total earnings before deductions. So, if an employee has basic pay of $2,000 and a bonus of $200, the employee's gross pay becomes $2,200 before deductions. Now, students, bonuses can be paid in different ways. A bonus can be paid to one employee. For example, one employee may receive a bonus because they performed extremely well. A bonus can be paid to a group of employees. For example, all members of the sales team may receive a bonus because the team exceeded the sales budget. A bonus can also be paid to all employees. For example, if the business has a very successful year, management may decide to give every employee a year-end bonus. So bonuses can be individual, team-based, or company-wide. Now let us look at some common reasons why bonuses may be paid. A bonus may be paid because a sales target was reached. For example, a salesperson receives a bonus after achieving a certain amount of sales. A bonus may be paid because production targets were reached. For example, factory workers may receive a bonus if they produce more units than the budgeted target. A bonus may be paid because profit targets were reached. For example, if the business earns more profit than expected, management may share part of that success with employees. A bonus may be paid because management wants to reward good performance. For example, an employee may receive a bonus for excellent customer service, strong attendance, or completing an important project. Now let us explain the link between bonuses and budgets. A budget is a plan for what the business expects to achieve. For example, a business may set a sales budget of $100,000 for the month. If the sales department sells $120,000, they have exceeded the budget. Management may then pay a bonus because the sales team achieved better results than planned. In a factory, the business may set a production budget. For example, the factory may plan to produce 10,000 units in a month. If the workers produce 12,000 units and quality is acceptable, the business may pay a bonus because output was higher than expected. So bonuses are often linked to performance targets. Now, students, it is important to understand that a bonus is different from overtime. Overtime is paid because an employee worked extra hours. A bonus is paid because a target or result was achieved. For example, if an employee works extra hours, they may receive overtime pay. But if an employee reaches a sales target, they may receive a bonus. Sometimes an employee may receive both. For example, Ahmed may work overtime during a busy month and also receive a bonus because the team exceeded its target. Both amounts are added to gross pay. Now let us also understand that a bonus is not always guaranteed. Basic pay is normally agreed in the employment contract, but a bonus may depend on performance, results, or management decision. For example, an employee may not automatically receive a bonus every month. They may only receive it if the target is reached. This is why employees should understand the rules for receiving a bonus. The business should also make the bonus rules clear. For example, what target must be reached? Who qualifies for the bonus? How is the bonus calculated? When will the bonus be paid? Is the bonus for individuals, teams, or all employees? Clear rules help avoid confusion and arguments. Now let us use another easy example. A factory employee normally earns $500 basic pay for the week. The factory sets a production target. If the employee produces more than the target, they receive a bonus of $50. This week, the employee reaches the target and qualifies for the bonus. So the employee's gross pay is $500 basic pay plus $50 bonus. That gives $550 gross pay before deductions. The employee may then have tax and other deductions taken away. After deductions, the employee receives net pay. Now, students, the accounting point is this. A bonus is part of the employee's earnings. Therefore, it is included in gross pay. It increases the payroll cost of the business. For the employee, it increases earnings. For the employer, it increases wages and salaries expense. This means bonuses must be recorded carefully in the payroll system. If the bonus is missed, the employee may be underpaid. If the bonus is recorded incorrectly, the payroll records may be wrong. If the bonus is paid without proper authorization, the business may lose control over payroll costs. So bonuses need approval and proper records. Now here is the key exam understanding. A bonus is an extra payment to reward results achieved. It is often used to motivate employees. It may be paid to one employee, a group of employees, or all employees. It may be linked to sales, production, profit, performance, or management decision. It is added to gross pay before deductions. So the big message of lesson 3.2 is this. Bonuses are extra rewards. They are used to encourage employees to reach targets and improve performance. When a bonus is earned, it becomes part of the employee's gross pay and must be recorded properly in the payroll system. Now we are studying lesson 3.3. The name of this lesson is commission. In the previous lessons, we learned about overtime and bonuses. Overtime is extra pay for working extra hours. A bonus is extra pay given as a reward for achieving a target or result. Now we are learning about commission. Commission is a payment made to an employee, or sometimes to an agent, based on the value of something that the employee or agent has generated. Most of the time, commission is based on sales. In very simple words, commission means extra pay earned because a person helped the business make sales. For example, imagine a salesperson sells goods worth $10,000. The business may reward that salesperson by giving them a percentage of the sales value. That reward is called commission. Commission is very common in sales jobs. For example, a car salesperson may earn commission when they sell a car. A real estate agent may earn commission when they help sell a house. An insurance agent may earn commission when they sell an insurance policy. A retail salesperson may earn commission when they sell expensive products. The main idea is simple. The more sales the employee makes, the more commission the employee may earn. Now, students, commission is usually added to the employee's pay. It becomes part of gross pay before deductions. Remember, gross pay means total pay before deductions. So if an employee receives basic pay and commission, both amounts are included in gross pay. For example, suppose an employee has basic pay of $900 for the month. During the month, the employee also earns commission of $200. The employee's gross pay is $900 plus $200. That gives $1,100 before deductions. Then, income tax and other deductions may be taken away. After deductions, the employee receives net pay. Now, let us understand why businesses use commission. The main reason is motivation. Commission encourages employees to sell more. If a salesperson knows that higher sales will give higher commission, they may work harder to find customers, explain products, follow up with clients, and close sales. This can help the business increase revenue. Revenue means income from sales, so commission can benefit both sides. The employee benefits because they can earn more. The employer benefits because the business may sell more. Now, the textbook tells us that commission is often based on the sales achieved. This means the business first looks at how much the employee sold and then calculates commission using the agreed rule. In many cases, commission is calculated on sales excluding sales tax. This means we normally calculate commission on the value of the sale before sales tax. Why? Because sales tax does not really belong to the business as income. It is collected from the customer and later paid to the tax authority. So commission is normally based on the actual sales value, not the tax amount. Now let us explain the common types of commission. The first type is straight percentage commission. Straight percentage commission means the employee receives the same percentage of all sales. For example, the commission rate may be 10% of all sales. If the employee makes sales of $1,000, the commission is $1,000 times 10% equals $100. If the employee makes sales of $10,000, the commission is $10,000 times 10% equals $1,000. So the rule stays the same. The employee receives 10% of whatever they sell. This method is simple and easy to understand. The higher the sales, the higher the commission. The second type is commission on a sliding scale. A sliding scale means the commission rate changes depending on the value of the sales or contracts. Usually, higher sales values receive a higher commission rate. For example, a business may say, sales up to $5,000 earn commission at 5%. Sales over $5,000 and up to $25,000 earn commission at 7.5%. This means the employee receives a better commission rate when the sales value becomes higher. Let us use a simple example. Suppose an employee sells a contract worth $4,000. Because this is up to $5,000, the commission rate is 5%. $4,000 times 5% equals $200. Now suppose the employee sells a contract worth $10,000. Because this contract is over $5,000, the commission may be calculated using the higher rate, depending on the rules of the business. This type of system encourages employees to sell larger contracts or more valuable products. The third type is commission that increases with the total volume of sales. This means the commission rate may increase after the employee passes a certain total sales target. For example, a business may say, sales up to $100,000 earn commission at 5%. If total sales exceed $100,000, the excess amount earns commission at 7.5%. Let us explain the word excess. Excess means the amount above the target. For example, if the target is $100,000 and the employee sells $120,000, the excess is $20,000. The first $100,000 may earn commission at 5%. The extra $20,000 may earn commission at 7.5%. This encourages the employee to go beyond the target. Now, students, do not confuse commission with bonus. A bonus is often a fixed reward or special extra payment for reaching a target. Commission is usually calculated directly from sales value. For example, if a salesperson receives 5% of sales, that is commission. But if the salesperson receives a fixed $1,000 reward because the team reached the monthly target, that is a bonus. Sometimes an employee may receive both commission and bonus. For example, a salesperson may receive 5% commission on sales and also receive a $1,000 bonus if total sales exceed a target. Both commission and bonus increase gross pay. Now let us use one clear example. Imagine Cassandra works for Bright Furniture Store. Her basic pay is $900 per month. She earns 5% commission on her sales. In January, she makes sales of $4,000. Her commission is $4,000 times 5%. That equals $200. So her gross pay for January is her basic pay of $900 plus commission of $200. That gives $1,100. Now imagine in February she sells $6,000. Her commission is $6,000 times 5%. That equals $300. Her gross pay for February is $900 plus $300. That gives $1,200. So when Cassandra sells more, her commission increases and her gross pay increases. This is the purpose of commission. Now, students, the accounting point is important. Commission is an employee earning. It is part of payroll. It must be recorded in the payroll system. It increases the wage or salary cost of the business. It also affects deductions because deductions are usually calculated from gross pay. So the payroll officer must calculate commission correctly. If commission is missed, the employee may be underpaid. If commission is calculated too high, the employee may be overpaid and the business cost will be wrong. If commission is based on sales, the business must also make sure the sales figures are correct. For example, the payroll officer should know whether commission is based on total sales, sales excluding sales tax, only paid sales, only completed sales, or sales after returns. The commission rules must be clear. Now here's the key exam understanding. Commission is extra pay based on the value of sales or another value generated by the employee or agent. It is often calculated as a percentage of sales. It may be a straight percentage on all sales. It may be on a sliding scale. It may increase when total sales pass a certain target. Commission is added to gross pay before deductions. So, the big message of Lesson 3.3 is this. Commission rewards employees for generating sales or value for the business. It motivates employees to sell more, and it must be calculated carefully using the correct sales value and the correct commission rate. Now we are studying Lesson 3.3.1. This lesson gives us an example of commission. The purpose of this example is to show that commission can be calculated in different ways for different employees. Two employees may work for the same business, but their commission rules may be different. One employee may receive commission using a step-by-step system. Another employee may receive a straight percentage on all sales. So in this lesson, we must focus carefully on the commission agreement for each employee. The business in the example is called the Bubbly Shampoo Company. This company sells crates of bubbly shampoo. Each crate is sold for $100. The company has two sales staff. The first employee is Michelle Thusela. The second employee is Jerry O'Bohm. Both employees receive commission, but their commission is calculated in different ways. Let us start with Michelle. Michelle receives a basic annual salary of $9,000 per year. Because we are calculating her monthly earnings for August, we must convert the annual salary into a monthly amount. $9,000 divided by 12 months gives $750. So Michelle's basic salary for August is $750. Now we must calculate Michelle's commission. Michelle's commission is not a simple percentage on all sales. Her commission uses different levels. This is like a sliding scale. Michelle receives no commission on the first 100 crates sold in a week. This means if she sells 100 crates or fewer in a week, she receives no commission for that week. She receives 10% commission on crates sold above 100 but below 200. She receives 15% commission on crates sold above 200 but below 300. She receives 20% commission on crates sold above 300. So for Michelle, we must calculate each week separately because the commission levels apply to weekly sales. Now let us look at Michelle's sales. In the first week, Michelle sold 120 crates. The first 100 crates earn no commission. Only the extra 20 crates earn commission. Each crate sells for $100. So the value of the extra 20 crates is $2,000. Michelle receives 10% commission on this amount. 10% of $2,000 is $200. So Michelle's commission for week 1 is $200. Now let us look at week 2. In week 2, Michelle sold 340 crates. This needs to be split into levels. The first 100 crates earn no commission. The next 100 crates are above 100 and up to 200. These earn 10% commission. The value of these 100 crates is $10,000. 10% of $10,000 is $1,000. The next 100 crates are above 200 and up to 300. These earn 15% commission. The value of these 100 crates is $10,000. 15% of $10,000 is $1,500. After 300 crates, Michelle still has 40 crates left because she sold 340 crates in total. These 40 crates are above 300, so they earn 20% commission. The value of 40 crates is $4,000. 20% of $4,000 is $800. Now add the commission for week 2, $1,000 plus $1,500 plus $800 gives $3,300. So Michelle's commission for week 2 is $3,300. Now let us look at week 3. In week 3, Michelle sold 30 crates. Because the first 100 crates earn no commission, 30 crates give no commission. So Michelle's commission for week 3 is nil. Nil means nothing. Now let us look at week 4. In week 4, Michelle sold 95 crates. Again, because the first 100 crates earn no commission, 95 crates give no commission. So Michelle's commission for week 4 is nil. Now we can calculate Michelle's total earnings for August. Her basic salary is $750. Her week 1 commission is $200. Her week 2 commission is $3,300. Her week 3 commission is nil. Her week 4 commission is nil. Total earnings for August are $750, plus $200, plus $3,300. That gives $4,250. So Michelle's total earnings for August are $4,250. Now let us move to Jerry. Jerry's commission system is much simpler. Jerry receives a basic annual salary of $4,500 per year. To find his monthly basic salary, we divide $4,500 by 12 months. That gives $375. So Jerry's basic salary for August is $375. Now Jerry receives a straight commission of 7.5% on all sales. Straight commission means the same commission rate applies to all sales. There are no levels. There is no first amount with no commission. There is no sliding scale. Jerry sold 500 crates in August. Each crate sells for $100. So the value of Jerry's sales is 500 crates times $100. That gives $50,000. Jerry receives 7.5% commission on $50,000. 7.5% of $50,000 is $3,750. Now calculate Jerry's total earnings for August. His basic salary is $375. His commission is $3,750. Total earnings are $375 plus $3,750. That gives $4,125. So Jerry's total earnings for August are $4,125. Now, students, let us compare the two employees. Michelle has a higher basic annual salary than Jerry. Michelle's annual salary is $9,000. Jerry's annual salary is $4,500. But Michelle's commission is more complicated. She does not receive commission on the first 100 crates each week. She only starts earning commission when her weekly sales pass 100 crates. Jerry has a lower basic salary, but his commission is simple. He receives 7.5% on all sales. This shows us an important payroll lesson. A higher basic salary does not always mean higher total earnings. A lower basic salary with strong commission can sometimes give high total earnings if sales are high. Now, here is the exam technique for commission examples. First, identify the basic salary. Second, convert annual salary into monthly salary if needed. Third, read the commission rules very carefully. Fourth, decide whether the commission is straight percentage commission or sliding scale commission. Fifth, calculate commission using the correct sales value. Sixth, add basic salary and commission to find total earnings. For Michelle, the commission must be calculated week by week because the rules apply to weekly sales. For Jerry, the commission is calculated on total monthly sales because he receives a straight percentage on all sales. The big message of Lesson 3.3.1 is this. Commission calculations depend completely on the agreement between the employer and the employee. Always read the commission rule carefully before calculating. Some commission is simple and some commission is split into levels. When the rule is understood, the calculation becomes much easier. Let us explain the first question after Lesson 3.3.1, together with its answer. This question is about commission and bonus. The employee is Cassandra. Cassandra works for a company that pays both bonuses and commission. Her basic pay is $900 per month. This means every month, before commission and bonus, Cassandra receives $900 as her normal pay. Now, the question also says that Cassandra receives commission of 5% of the sales she made in the previous month. This is a very important point. The commission is not paid in the same month as the sale. It is paid 1 month later. For example, the commission for January sales is paid at the end of February. The commission for February sales is paid at the end of March. The commission for March sales is paid at the end of April. So when we calculate gross pay for a month, we must use the previous month's sales for commission. The question also gives another rule. If Cassandra's sales exceed $10,000 in any quarter, she gets a one-off bonus of $1,000. A quarter means a 3-month period. The first quarter is January, February, and March. The second quarter is April, May, and June. The third quarter is July, August, and September. The fourth quarter is October, November, and December. The bonus is paid in the month after the quarter. So if the sales target is achieved in January to March, the bonus is paid in April. Now let us look at the sales figures. Cassandra's sales in December 20x1 were $5,000. In January 20x2, sales were $5,000. In February, sales were $4,000. In March, sales were $3,000. In April, sales were $2,000. In May, sales were $3,000. In June, sales were $4,000. The question asks what will be included in her gross pay at the end of each month from January to June inclusive. Remember, gross pay means total pay before deductions. So every month we must include basic pay, commission based on the previous month's sales, bonus, only if a quarter target has been achieved and the bonus is due in that month. Now let us calculate month by month. For January, Cassandra receives her basic pay of $900. She also receives commission for the previous month, which is December 20x1. December sales were $5,000. Commission is 5% of $5,000. 5% of $5,000 is $250. So January gross pay is $900 plus $250. That gives $1,150. For February, Cassandra receives basic pay of $900. She also receives commission for January sales. January sales were $5,000. Commission is 5% of $5,000. That gives $250. So February gross pay is $900 plus $250. That gives $1,150. For March, Cassandra receives basic pay of $900. She also receives commission for February sales. February sales were $4,000. Commission is 5% of $4,000. That gives $200. So March gross pay is $900 plus $200. That gives $1,100. Now we come to April. For April, Cassandra receives basic pay of $900. She also receives commission for March sales. March sales were $3,000. Commission is 5% of $3,000. That gives $150. Now we must also check whether a bonus is payable. The first quarter is January, February, and March. January sales were $5,000. February sales were $4,000. March sales were $3,000. Total sales for the first quarter are $12,000. $12,000 is more than $10,000. So Cassandra has exceeded the quarterly sales target. Because the bonus is paid in the month after the quarter, the $1,000 bonus is paid in April. So April gross pay is basic pay of $900 plus commission of $150 plus bonus of $1,000. That gives $2,050. For May, Cassandra receives basic pay of $900. She also receives commission for April sales. April sales were $2,000. Commission is 5% of $2,000. That gives $100. There is no bonus paid in May because the first quarter bonus was already paid in April and the second quarter has not finished yet. So May gross pay is $900 plus $100. That gives $1,000. For June, Cassandra receives basic pay of $900. She also receives commission for May sales. May sales were $3,000. Commission is 5% of $3,000. That gives $150. There is no bonus paid in June. So June gross pay is $900 plus $150. That gives $1,050. Now let us summarize the answers clearly. At the end of January, Cassandra's gross pay is $1,150. At the end of February, Cassandra's gross pay is $1,150. At the end of March, Cassandra's gross pay is $1,100. At the end of April, Cassandra's gross pay is $2,050. At the end of May, Cassandra's gross pay is $1,000. At the end of June, Cassandra's gross pay is $1,050. The most important exam points are these. First, commission is paid 1 month after the sales are made. So always use the previous month's sales for commission. Second, the bonus is based on quarterly sales. So we add the sales for the 3 months in the quarter. Third, the bonus is paid in the month after the quarter. So the January to March bonus is paid in April. The big lesson from this question is that gross pay can include basic pay, commission, and bonus at the same time. To answer correctly, we must read the timing rules carefully. Let us explain the second question after lesson 3.3.1 together with its answer. This question is about a salaried employee. The employee is Dilys. Dilys is paid a salary, but she can also receive overtime and a productivity bonus. So this question is testing whether we can calculate gross pay when there are several parts of pay together. Remember, gross pay means total earnings before deductions. In this question, Dilys may receive 4 things in May: her basic monthly salary, her overtime pay, her productivity bonus, her back pay from the salary increase. Let us go step by step. First, the question says Dilys receives overtime of $10 per hour for hours worked over 156 hours in a month. This means the first 156 hours are covered by her normal salary. Only hours above 156 hours are overtime hours. In May, Dilys worked 175 hours, so we calculate overtime hours like this. 175 hours minus 156 hours gives 19 hours. So Dilys worked 19 overtime hours in May. Her overtime rate is $10 per hour. 19 hours times $10 gives $190. So her overtime pay is $190. Now let us calculate her basic monthly salary. Her salary was increased to $15,000 per year. This new salary applies from the 1st of May, but it is also backdated to the 1st of January. First, for May itself, we use the new annual salary of $15,000. Because salary is paid monthly, we divide the annual salary by 12 months. $15,000 divided by 12 months gives $1,250. So Dilys's basic salary for May is $1,250. Now, let us calculate the productivity bonus. The question says she receives a productivity bonus of 5% of her basic monthly salary if the quality of her work exceeds expectations. In May, she produced work of better quality than standard. This means she qualifies for the productivity bonus. The bonus is 5% of her basic monthly salary. Her basic monthly salary is $1,250. 5% of $1,250 gives $62.50. So her productivity bonus is $62.50. Now we must calculate back pay. This is the part many students may forget. Dilys's salary was increased from $12,000 per year to $15,000 per year. The increase was agreed on the 1st of May, but it was backdated to the 1st of January. Backdated means the increase is treated as if it started earlier. So even though the agreement happened in May, Dilys should receive the extra pay for January, February, March, and April. First, calculate the annual salary increase. $15,000 minus $12,000 gives $3,000. So her annual salary increased by $3,000. Now we need the back pay for 4 months, from January to April. $3,000 for a full year means $3,000 divided by 12 months. That gives $250 per month. For 4 months, the back pay is $250 times 4 months gives $1,000. So Dilys receives $1,000 as back pay in May. Now let us add all the parts of her May gross pay. Basic salary for May is $1,250. Overtime pay is $190. Productivity bonus is $62.50. Back pay is $1,000. Now add them together. $1,250 plus $190 gives $1,440. $1,440 plus $62.50 gives $1,502.50. $1,502.50 plus $1,000 gives $2,502.50. So Dilys's gross pay in May is $2,502.50. Now students, let us understand the exam technique. When a question gives salary, overtime, bonus, and back pay, do not calculate only one part. You must identify every item included in gross pay. For this question, the correct structure is basic salary for May, overtime for hours above 156 hours, Productivity bonus because the quality of work exceeded expectations. Back pay because the salary increase was backdated to the 1st of January. The final answer is Dillis will receive gross pay of $2,502.50 in May. The big lesson from this question is this: gross pay can include more than basic salary. It may also include overtime, bonuses, and backdated salary increases. Always read the timing and conditions carefully before calculating the final gross pay. Now we are moving to Lesson 4 of Chapter 17. The name of this lesson is Payroll Administration and Documentation. In the earlier lessons, we learned how payroll amounts can be calculated. We studied basic pay, gross pay, overtime, bonuses, commission, and other extra earnings. Now, Lesson 4 is different. This lesson is not mainly about calculating pay. It is about the records and documents needed to support payroll. In simple words, payroll administration means the paperwork, records, procedures, and systems used to manage employee pay properly. A business cannot just pay employees from memory. It needs evidence. It needs documents. It needs records showing who worked, how much they worked, what they should be paid, what deductions were made, and why. This is very important because payroll affects employees, the employer, and the government. Employees want to be paid correctly. The employer wants to control payroll costs. The government wants the correct tax and other deductions to be collected. So, payroll documents help the business prove that payroll has been calculated properly. The textbook tells us that there are a number of documents associated with payroll preparation. Let us explain the main ones. The first document is the timesheet. A timesheet records the hours spent by each employee. It may show how many hours the employee worked on each job, or how many hours the employee spent working for each client. For example, imagine an employee works for a repair company. On Monday, the employee spends 3 hours repairing equipment for client A. Then the employee spends 4 hours repairing equipment for client B. The timesheet records these hours. This helps the business know how much time was spent on each job or client. Timesheets are very useful when employees are paid hourly or when the business needs to charge customers for labor time. For example, if a business charges customers based on employee hours, the timesheet becomes evidence for customer billing as well as payroll. The second document is the attendance record. An attendance record shows whether the employee attended work or was absent. It may record sickness, holidays, unpaid leave, lateness, or other absences. The personnel department uses attendance records to understand why employees were absent from work. For example, if Sarah was absent for 2 days because she was sick, the attendance record should show that. If Ahmed was away for annual leave, the attendance record should show that. If Maria was absent because of a family emergency, that may also be recorded. Attendance records are important because absence can affect pay. For example, some employees may receive paid sick leave. Some employees may receive unpaid leave. Some employees may have holiday entitlement. The business needs proper records to calculate pay correctly. Attendance records are also used to administer annual leave. Annual leave means paid holiday time that the employee is entitled to take. For example, an employee may be allowed 4 weeks of annual leave each year. The personnel department needs to record how many days have been taken and how many days are still available. The third type of documentation is other personnel records. Personnel records are records about the employee and their employment history. These may include records of the employee's career progress. For example, the records may show when the employee joined the business, what position they started in, when they were promoted, what training they completed, and whether their salary changed. These records help the business manage employees properly. Now, students, the main idea of Lesson 4 is this: payroll needs documents. Without proper documents, payroll can become inaccurate, unfair, and difficult to control. For example, if there is no timesheet, the business may not know how many hours an hourly employee worked. If there is no attendance record, the business may not know whether an absence should be paid or unpaid. If there is no personnel record, the payroll department may not know the correct salary, job title, or pay rate. So payroll administration and documentation help make payroll accurate, controlled, and reliable. Lesson 4.1, Personnel Department. Now we move to Lesson 4.1. The name of this lesson is Personnel Department. The Personnel Department is the department responsible for employees. In modern business, this department may also be called the Human Resources Department. Its job is not usually to process payroll every day. Its main job is to manage employee information and employee records. The textbook explains that the Personnel Department is responsible for recruiting and engaging employees. Recruiting means finding suitable people for jobs. Engaging employees means officially employing them and bringing them into the organization. For example, if Bright Stationery Store needs a new cashier, the Personnel Department may advertise the job, receive applications, arrange interviews, select the employee, and prepare the employment records. After the employee is hired, the Personnel Department keeps basic data about that employee. This data is very important because payroll needs correct employee information. One important record is the personal record card. A personal record card is a record completed for each employee. It may show personal details and a summary of the employee's employment history with the organization. For example, it may show the employee's name, address, date of joining, job title, department, salary or wage rate, and other employment details. This record helps the business know who the employee is and what their employment position is. Another important record is the attendance card. The attendance card helps the Personnel Department review the number of days the employee was absent from work. It can show absences due to sickness, holidays, or other special reasons. For example, if an employee was away because of sickness for 3 days, the attendance card records this. If the employee took annual leave for 1 week, the attendance card records this. If the employee was absent because of bereavement, which means death in the family, this may also be recorded. These records help the business manage leave, absence, and payroll correctly. Now let us connect this to payroll. Suppose an employee is paid monthly. If the employee worked the full month, the payroll calculation may be simple. But if the employee had unpaid leave, sickness leave, or a salary change, the payroll department needs accurate information from personnel records. For example, if an employee's salary increased from the 1st of July, the payroll department must know the new salary and the date it starts. If the employee left the company during the month, the payroll department must know the leaving date. If the employee took unpaid leave, the payroll department must know how many days were unpaid. So the Personnel Department provides important information to payroll. The textbook also explains that this information may be held on computer. A computer personnel system may have a main menu with sections such as personal details, job and salary, training, and exit. Personal details may include the employee's name, address, contact details, and other basic information. Job and salary may include the employee's job title, department, salary, wage rate, and pay changes. Training may include courses attended, qualifications, and skills development. Exit may include information when the employee leaves the organization. Even if the information is stored on a computer instead of paper cards, the purpose is the same. The business must keep accurate employee records. Now, students, here is another important point. The Personnel Department may be involved in setting wage and salary levels. This means personnel may help decide how much employees should be paid. For example, personnel may compare pay rates in the market, help decide salary bands, or advise management about pay increases. But the Personnel Department is not usually involved in the day-to-day payroll process. Day-to-day payroll process means calculating the actual pay each week or month, making deductions, preparing payslips, and arranging payments. That work is normally done by the payroll department or accounts department, so we must understand the difference. The personnel department keeps employee information. The payroll department uses that information to calculate and pay wages or salaries. Let us use a simple example. Bright Stationery Store hires a new employee called Sarah. The personnel department records Sarah's personal details. It records her job title. It records her salary. It records her start date. It records her annual leave entitlement. Later, the payroll department uses this information to pay Sarah correctly. If Sarah receives a salary increase, the personnel department updates the record and tells payroll. If Sarah takes annual leave, the personnel department records it. If Sarah leaves the business, the personnel department records the exit information and informs payroll. This shows how personnel records and payroll processing work together. Now, students, the key lesson is this. Payroll depends on good documentation. Timesheets show hours worked. Attendance records show absences and leave. Personnel records show employee details, job history, salary information, training, and leaving information. The personnel department manages employee records and provides important information to payroll. The payroll department then uses that information to calculate wages and salaries accurately. So the big message of Lesson 4 and Lesson 4.1 is this. A good payroll system is not only about calculations. It also needs proper documents and accurate employee records. Without good payroll administration and personnel records, the business may pay employees incorrectly, make wrong deductions, or fail to keep proper evidence. Now we are studying Lesson 4.2. The name of this lesson is Payroll Function. In the previous lesson, we learned about the personnel department. The personnel department keeps employee records, such as employee details, job title, salary rate, attendance records, training records, and leaving information. Now we move to the payroll function. The payroll function means the part of the business that calculates employee pay, prepares payroll records, deals with deductions, and makes sure employees are paid correctly. In some businesses, payroll is handled by a separate payroll department. In other businesses, payroll may be handled by staff inside the accounts department. For example, a large company may have a full payroll department because it has many employees, but a small business may have one accounts assistant or accountant who deals with payroll as part of their normal accounting work. The important point is this. Whether payroll is a separate department or part of the accounts department, the payroll work must be accurate, timely, secure, and properly documented. Now let us explain the main duties of the payroll function. The first duty is calculation of gross pay. Gross pay means the total amount earned by the employee before deductions. This may include basic pay, overtime, bonuses, commission, back pay, and other earnings. For example, if an employee earns basic pay of $2,000 and overtime of $200, the gross pay is $2,200 before deductions. So the payroll department must first calculate the employee's full earnings. This is very important because if gross pay is wrong, everything after that will also be wrong. The deductions may be wrong. The net pay may be wrong. The accounting records may be wrong. The second duty is calculation of tax, national insurance, and other deductions. A deduction is an amount taken away from gross pay. For example, income tax may be deducted from the employee's pay. In the United Kingdom, national insurance may also be deducted. In other countries, similar deductions may have different names. There may also be other deductions, such as pension contributions, benefit contributions, union deductions, loan repayments, or other authorized deductions. The payroll department must calculate these deductions correctly. Why is this important? Because the employee must not be overpaid or underpaid. The government must receive the correct tax and contributions. The employer must keep proper payroll records. For example, if an employee's gross pay is $2,000, the payroll department may deduct income tax and other contributions. After deductions, the employee receives net pay. Net pay means the amount actually paid to the employee. So the payroll department must calculate both gross pay and deductions before finding net pay. The third duty is preparing payslips. A payslip is a document given to an employee showing how their pay was calculated. A payslip usually shows gross pay, deductions, and net pay. It may show basic pay, overtime, bonus, commission, income tax, benefit contributions, pension deductions, and the final amount paid. Payslips are important because employees need to understand their pay. For example, if an employee receives less money than expected, the payslip helps explain why. Maybe tax was deducted, maybe pension contributions were deducted, maybe unpaid leave was taken, maybe overtime was not included. So the payslip gives evidence and transparency. The fourth duty is making appropriate returns to external agencies. External agencies means organizations outside the business. For payroll, the most important external agency is usually the tax authority. The employer may need to send payroll information to the tax authority, such as total pay, tax deducted, benefit contributions, and other required payroll details. The employer may also need to send information or payments to pension providers, benefit contribution offices, or other organizations. This means payroll is not only an internal business task. Payroll also connects the business with outside authorities. If returns are late or incorrect, the business may face penalties or problems. So the payroll department must make sure returns are prepared accurately and submitted on time. The fifth duty is making up wages or preparing information for bank transfer. In older systems, employees may have been paid in cash. The payroll department would prepare wage packets. In modern businesses, employees are often paid by bank transfer. The payroll department may prepare the bank payment file or payment instruction so that the correct net pay is sent to each employee's bank account. This must be controlled carefully. The business must make sure the correct employee is paid. The correct amount must be paid. The correct bank account must be used. The payment must be authorized before it is made. For example, if an employee's bank details are entered wrongly, the pay may go to the wrong account. If a fake employee is added to payroll, money may be stolen. So payroll payments need strong control. The sixth duty is distributing payslips. After payslips are prepared, they must be given to employees. This may be done on paper or electronically. Payslips are confidential because they contain private pay information. They should only be given to the correct employee or made available securely through an authorized system. For example, one employee should not see another employee's payslip. Pay information must be protected. The seventh duty is preparing payroll statistics. Payroll statistics are summaries and reports about payroll. For example, management may want to know total wages for the month, overtime costs, payroll cost by department, number of employees, average pay, bonus costs, or commission costs. These statistics help management control labor costs. For example, if overtime costs are increasing every month, management may investigate why. Maybe the business needs more staff. Maybe work is not being planned properly. Maybe some departments are using too much overtime. So payroll statistics help the business make decisions. Now, students, let us connect the personnel department and the payroll function. The personnel department keeps employee information. The payroll department uses that information to calculate pay. For example, the personnel department may tell payroll, "This employee has started work. This employee's salary is $3,000 per month. This employee's salary increase starts from the 1st of July. This employee has taken unpaid leave. This employee has left the business." Then the payroll department uses this information to calculate the correct pay. So personnel provides the information and payroll performs the calculation and payment process. The big message of Lesson 4.2 is this. The payroll function is responsible for calculating pay, calculating deductions, preparing payslips, making payments, sending returns to external agencies, distributing payslips, and preparing payroll reports. It is a key control function because payroll involves money, employees, tax, deductions, and confidential information. Lesson 4.3. Documentation for salaried employees. Now we move to lesson 4.3. The name of this lesson is Documentation for Salaried Employees. A salaried employee is an employee who is paid a fixed salary, usually for a year, divided into regular payments such as monthly payments. For example, an employee may have an annual salary of $36,000. If the employee is paid monthly, the basic monthly salary is $3,000. The important point is that salaried employees are not usually paid based on hours worked each day. They are normally paid based on the agreed salary in their employment record. So payroll needs proper documentation to know how much salary should be paid and from which date. The textbook explains that personnel records held in the personnel department document how much each salaried employee is to be paid and for what periods. Let us explain that. The personnel department keeps the official records about the employee's salary. These records may show the employee's current salary, job title, department, start date, salary increase date, and any changes to pay. For example, the personnel record may show that Sarah is paid $30,000 per year from the 1st of January. Later, it may show that Sarah's salary increased to $33,000 per year from the 1st of July. This is very important for payroll. The payroll department must pay Sarah using the correct salary for the correct period. If payroll uses the old salary after the pay rise date, Sarah will be underpaid. If payroll uses the new salary too early, Sarah will be overpaid. So the effective date is very important. The effective date means the date from which a salary rate starts. For salaried employees, the personnel department usually tells the payroll department two main things. First, how much the employee is to be paid. Second, the date from which that rate of pay is effective. For example, personnel may tell payroll, Ahmed's annual salary is $48,000, effective from the 1st of April. This means payroll should calculate Ahmed's salary using $48,000 per year from the 1st of April onwards. If employees are paid monthly, payroll divides the annual salary by 12 months to find the monthly salary. Now, the textbook also explains that the payroll department will receive instructions from the personnel department relating to salary increases or other alterations to an employee's pay. An alteration means a change. There are many possible changes to an employee's pay. For example, the employee may receive a salary increase. The employee may receive a promotion and move to a higher salary. The employee may move from full-time to part-time. The employee may take unpaid leave. The employee may start receiving an allowance. The employee may stop receiving an allowance. The employee may leave the business part way through the month. All these changes must be communicated to payroll. Payroll should not guess these changes. Payroll needs proper instructions from personnel. Why? Because payroll must be based on authorized information. For example, if an employee says, "My salary increased this month," payroll should not change the pay just because the employee said so. Payroll needs official confirmation from personnel or management. This protects the business from errors and unauthorized payments. Now, let us use a simple example. Imagine Bright Stationery Store has an employee called Maria. Maria is a salaried employee. Her annual salary is $36,000. She is paid monthly, so her monthly salary is $3,000. The personnel department keeps Maria's salary record. Later, Maria is promoted and her salary increases to $42,000 per year from the 1st of October. The personnel department sends an instruction to the payroll department. The instruction says Maria's new salary is $42,000 per year, effective from the 1st of October. Now, payroll must use the old salary up to September and the new salary from October. The new monthly salary is $42,000 divided by 12 months, which gives $3,500 per month. So Maria should receive $3,000 per month before October and $3,500 per month from October onwards. This example shows why payroll documentation must include both the amount and the effective date. Now, students, the main control point is this. For salaried employees, payroll should rely on official personnel records and authorized instructions. This helps prevent mistakes and fraud. For example, without proper documentation, an employee could be paid at the wrong rate. A salary increase could be missed. A salary increase could be applied twice. A person who left the business could continue to be paid. An unauthorized allowance could be added. Proper documentation protects the business and the employee. So the big message of Lesson 4.3 is this. For salaried employees, the Personnel Department keeps records showing how much each employee should be paid and from what date. The Payroll Department uses those records and official instructions to calculate salary correctly. Any salary increase or change to pay must be properly authorized and communicated to payroll. Now we are studying Lesson 4.4. The name of this lesson is Documentation for Hourly Paid Employees. This is a very important lesson because hourly paid employees are not normally paid a fixed salary every month. Instead, their pay depends on the number of hours they work, or in some cases, the amount of work they produce. Because of this, the business must keep accurate records. Without proper records, the payroll department cannot calculate wages correctly. The main idea of this lesson is simple. Hourly paid employees must have reliable documents that prove how much work they have done before payroll is calculated. Let us go through the lesson step by step. The first document is the attendance record. The textbook explains that hours of attendance can be recorded in a register. Employees may write down their arrival time and departure time themselves. In many businesses, this is done using a time recording clock. The employee inserts a card into the machine, and the machine records the exact time the employee starts work and the exact time the employee finishes work. Today, many businesses use electronic systems such as swipe cards, fingerprint scanners, face recognition systems, or mobile applications instead of paper cards. Although the technology may change, the purpose is always the same. The business must know exactly when each employee started work and when they finished work. This information becomes the starting point for payroll. The next important document is the attendance card. Attendance cards are the basis for payroll preparation. The textbook explains that pre-printed forms are used. These forms allow the payroll department to record gross wages, deductions, and finally, the employee's net pay. So the attendance card is much more than just a record of arrival and departure. It is one of the main documents used to calculate payroll. Now let us see how gross wages are calculated. For time workers, gross wages are calculated from three important pieces of information: the amount of time worked, the employee's rate of pay, any overtime premium, bonus, or other additional payments. For example, imagine an employee works for 8 hours and earns $20 per hour. The payroll department first calculates the basic wages using the hours worked and the hourly rate. Then it adds any overtime, bonus, or other additional earnings to arrive at the employee's gross pay. Now let us look at piece workers. Piece workers are different from time workers. A piece worker is paid according to the number of units produced instead of the number of hours worked. For piece workers, gross wages are normally calculated using three things: the number of good units produced, the payment rate for each unit, any bonus, premium, or allowance for incomplete jobs. For example, suppose a worker receives $5 for every item produced. If the worker produces 100 good items, the basic piecework pay is $500. If the business also pays a production bonus, that bonus is added to the gross pay. This shows an important difference. Time workers are paid mainly for time. Piece workers are paid mainly for output. Now, the textbook explains another important activity called job time booking. Job time booking means recording how much time an employee spends on each individual job. This can be done manually or by using a time recording device. The method used depends on the size of the organization and the type of work being carried out. Why is job time booking important? Imagine a company repairs computers. An employee may spend 2 hours repairing one customer's computer and 3 hours repairing another customer's computer. The business must know exactly how much time was spent on each customer's job. This information helps the business charge customers correctly and also helps management understand labor costs. The textbook then introduces several important payroll documents. The first is the daily timesheet. A daily timesheet is completed by the employee. It records the time spent on each job during that day. The total time recorded on the daily timesheet should match the total attendance time recorded for that employee. In other words, the employee cannot claim to have worked 10 hours on different jobs if the attendance record shows only 8 hours at work. The two records must agree. The second document is the weekly timesheet. A weekly timesheet is very similar to a daily timesheet. The difference is that it covers the whole week instead of only one day. The textbook recommends that information should be entered every day instead of waiting until the end of the week. Why? Because people may forget the exact jobs they worked on if they wait too long. Daily recording is more accurate. The third document is the job card. A job card is prepared for each individual job. The time spent by each employee working on that job is recorded on the job card. Think of the job card as the history of one specific job. It tells the business who worked on that job, how long they worked, and what labor cost belongs to that job. For example, if a construction company is building a house, there may be a separate job card for that house. Every carpenter, electrician, and plumber records the time spent on that specific project. This helps the company calculate the total labor cost of building the house. The fourth document is the route card. A route card is similar to a job card, but it follows the product as it moves through different stages of production. Instead of recording only one job, it records every operation that must be completed before the product is finished. For example, imagine a factory that manufactures office chairs. The chair may move through cutting, welding, painting, assembly, inspection, and packaging. The route card follows the chair through each department. It records the work completed at every stage. This helps management monitor production and calculate production costs accurately. Now let us look at the timesheet shown in the textbook. Although it may look complicated, it is actually recording simple information. It includes the employee's name. It includes the employee number. It includes the date. It includes the job number. It records the start time. It records the finish time. It records the quantity produced where appropriate. It records who checked the work. It records the total hours worked. It records the hourly rate. Finally, it records the labor cost for that work. Each of these pieces of information has an important purpose. The employee completes the timesheet while carrying out the work. The payroll department later uses this information to calculate wages. The accounting department uses the same information to calculate labor costs. The production department uses it to monitor efficiency. The management team uses it to control costs and improve productivity. The textbook also explains that the employee completes the timesheet by recording the hours worked on each job or work area. Idle time should also be recorded. Idle time means time when the employee is being paid but is not actively producing work. For example, machinery may break down, materials may not arrive, or the employee may be waiting for instructions. Lunch breaks and other breaks may also be recorded where required. Another important point is that a job card tells the employee what work needs to be completed and how long the work is expected to take. The employee then records the actual starting time and finishing time. This allows the business to compare the planned time with the actual time. If a job was expected to take 2 hours but actually took 4 hours, management can investigate why. Perhaps the work was more difficult than expected. Perhaps equipment failed. Perhaps additional training is needed. These records help improve efficiency. Now, students, let us bring everything together with one simple example. Imagine Bright Furniture Company employs Ali as an hourly paid worker. Ali arrives at work at 8 o'clock in the morning and leaves at 5 o'clock in the afternoon. His attendance record confirms that he was at work. During the day, Ali spends 3 hours making office desks and 5 hours making bookshelves. He records these hours on his daily timesheet. Each product also has its own job card showing how much labor time was spent on that product. At the end of the day, the payroll department uses Ali's attendance record and timesheet to calculate his wages. The accounting department uses the job cards to calculate the labor cost of each product. Every department is using the same information, but for a different purpose. Now let us finish with the key exam points. For hourly paid employees, accurate documentation is essential. Attendance records prove when employees were at work. Attendance cards provide the basis for payroll calculations. Daily and weekly timesheets record the time spent on each job. Job cards record labor time for individual jobs. Route cards follow products through each stage of production. All of these records help the payroll department calculate wages correctly, help the accounting department calculate labor costs correctly, and help management control productivity and business costs. The big message of Lesson 4.4 is this: a payroll system is only as accurate as the documents that support it. If the attendance records, timesheets, job cards, and route cards are completed accurately, the business can calculate wages correctly, control labor costs, charge customers accurately, and maintain reliable accounting records. Now we are studying Lesson 4.5. The name of this lesson is Timesheets and Salaried Staff. In Lesson 4.4, we learned that hourly paid employees often need timesheets because their pay depends on the number of hours they work. Now, the textbook asks us to think about salaried staff. A salaried employee is usually paid a fixed salary. For example, an employee may receive $36,000 per year, paid in 12 equal monthly amounts. This means the employee receives $3,000 per month before deductions. Because the employee is paid a fixed salary, you may think, why does a salaried employee need to complete a timesheet? If the salary is fixed, why record every hour? That is a very good question. At first, it may look unnecessary, but in many businesses, salaried employees are still required to complete timesheets. The reason is that timesheets are not used only for calculating wages. Timesheets can also be used for management information, customer billing, overtime support, and cost control. Let us explain this carefully. The first reason is management information about product costs and profitability. A business needs to know how much labor time is spent on each product, job, project, or department. Even if the employee receives a fixed salary, their time still has a cost to the business. For example, imagine an accountant in a company receives a fixed monthly salary. During the month, that accountant works on 3 different clients. The company may want to know how much time was spent on client A, how much time was spent on client B, and how much time was spent on client C. Why? Because the business wants to know whether each client is profitable. Profitability means whether the work earns enough income compared with the cost of doing the work. For example, if a client pays the business $500, but the employee spends many hours on that client, the work may not be profitable. So the timesheet helps management calculate the cost of the work. It helps answer questions such as, which job took the most time? Which customer is profitable? Which department uses the most staff time? Which product is expensive to produce? Where is staff time being wasted? So even for salaried employees, timesheets can help management understand costs and make better decisions. The second reason is that timesheet information may directly affect the revenue the organization receives. Revenue means income earned by the business. Some businesses charge customers based on the number of hours spent on their work. This is very common in service businesses. For example, solicitors, accountants, consultants, architects, designers, and repair companies may charge clients based on staff time. Imagine a consulting business charges clients $100 for each hour of staff time. If a salaried employee spends 5 hours working for a client, the business may charge the client $500. If the employee does not record those hours properly, the business may charge too little and lose income, So the timesheet becomes very important because it supports the invoice sent to the customer. In this case, the timesheet is not mainly for calculating the employee's salary. The employee may still receive the same salary, but the timesheet helps the business calculate how much to charge the client. Let us use a simple example. Bright Consulting Company employs Sarah as a salaried employee. Sarah receives a fixed salary every month. During 1 week, Sarah works 6 hours for client Alpha, 4 hours for client Beta, and 3 hours for client Gamma. Sarah records this on her timesheet. Bright Consulting Company uses Sarah's timesheet to prepare invoices for those clients. So even though Sarah's pay is fixed, her timesheet helps the business earn the correct revenue. The third reason is that timesheets support claims for overtime when overtime is paid to salaried staff. Some salaried employees may still receive overtime pay. For example, a salaried employee may have normal working hours, but if they work extra hours, the business may pay overtime. In that case, the timesheet provides evidence of the extra hours worked. Without a timesheet, it may be difficult to prove how many overtime hours were worked. For example, imagine Maria is a salaried employee. Her normal monthly salary covers her regular hours. But during a busy month, she works 10 extra hours and the company pays overtime for approved extra work. Maria's timesheet records those extra hours. The payroll department can then calculate overtime correctly. So timesheets help support overtime payments. Now let us connect this to the type of businesses mentioned in the lesson. The textbook explains that the timesheet shown is the type that may be found in large firms in the service sector of the economy. The service sector includes businesses that sell services instead of physical goods. Examples include solicitors, accountants, consultants, engineers, designers, and similar professional firms. These businesses mainly sell the time, knowledge, and expertise of their employees. Expertise means special skill or professional knowledge. For example, an accountant sells accounting knowledge. A solicitor sells legal knowledge. A consultant sells business advice. A designer sells design skill. In these businesses, time is extremely important because time is what the client is paying for. So if an employee spends 1 hour working for a client, the client may be charged for 1 hour of professional time. This is why salaried staff in service businesses often complete detailed timesheets. The business needs to know exactly how much time was spent on each client. Now let us explain the timesheet shown in the lesson. A weekly timesheet may record the employee's name. It may record the staff number. It may record the week ending date. It may record the client or non-chargeable time description. It may record the code number. It may record the charge account number. It may record the total hours worked. It may record the hours spent each day. It may record whether the time is chargeable or non-chargeable. Chargeable time means time that can be charged to a client. Non-chargeable time means time that cannot be charged directly to a client. For example, if an accountant spends 3 hours preparing a client's accounts, that may be chargeable time. But if the accountant spends 1 hour in internal staff training, that may be non-chargeable time. Both types of time are important. Chargeable time helps the business bill clients. Non-chargeable time helps management understand how staff time is being used. For example, if employees spend too much time on non-chargeable activities, the business may become less profitable. Now let us use a detailed example. Imagine Bright Accountancy Firm has an employee called Ahmed. Ahmed is paid a fixed salary every month. During 1 week, Ahmed works on 3 clients. He spends 10 hours on client 1. He spends 8 hours on client 2. He spends 6 hours on client 3. He also spends 4 hours in internal training and 2 hours in an internal staff meeting. Ahmed records all this time on his weekly timesheet. The firm uses the client hours to prepare invoices. The firm also uses the internal hours to understand how much staff time is spent on training and meetings. Ahmed's salary may not change because of the timesheet, but the timesheet still gives the firm very important information. It helps with billing. It helps with cost control. It helps with management reports. It helps with planning. It helps with checking whether staff time is being used efficiently. Now, students, here is the key exam focus. Wages and salaries are a significant item of expenditure for most businesses. This means payroll cost is often one of the biggest expenses. Because payroll cost is large, the exam may ask questions about payroll records, timesheets, or calculations such as net pay. So you should be prepared for questions that ask why payroll records are needed, why salaried employees may complete timesheets, or how payroll information is used. The main point is this: timesheets are not only for hourly paid workers. They can also be useful for salaried staff. For salaried staff, timesheets may be used to calculate product costs, measure profitability, support customer billing, and provide evidence for overtime claims. So the big message of Lesson 4.5 is this: even when employees are paid a fixed salary, their time still has value. A timesheet helps the business know where that time was spent, how much work was done for each client or job, how much should be charged to customers, and whether overtime should be paid. This makes timesheets an important control and management tool, even for salaried staff. Now we are moving to Lesson 5 of Chapter 17. The name of this lesson is Payroll Deductions. In the previous lessons, we learned how employees earn pay. We studied basic pay, overtime, bonuses, commission, and gross pay. Now we must learn what happens after gross pay is calculated. This is where payroll deductions come in. A payroll deduction is an amount taken away from an employee's gross pay before the employee receives net pay. Let us make this very simple. Gross pay means the total amount the employee earns before deductions. Net pay means the amount the employee actually receives after deductions. So the employee may earn a certain amount, but they may not receive all of it. Some amounts are deducted first. For example, an employee may earn $1,200 as gross pay. But after income tax, benefit contributions, and other deductions, the employee may receive only $910. That $910 is the net pay. Now, students, remember this important idea. The employee's wage packet, paycheck, or bank transfer is normally the net pay, not the gross pay. The gross pay is what the employee earned. The net pay is what the employee actually receives. Lesson 5 tells us that income tax and benefit contributions are normally deducted from an employee's gross pay before net pay is handed over. This means the employer calculates the employee's total earnings first. Then the employer takes away required deductions. Then the remaining amount is paid to the employee. Let us use the example shown in the lesson. The employee's gross pay is $1,000. The employee also has other pay, such as statutory sick pay, statutory maternity pay, or holiday pay of $200. So the total gross pay is $1,200. Now, deductions are taken away. Income tax is $140. Benefit contributions are $100. Other deductions are $50. Total deductions are $290. Now, the employee's net pay is $910. So the employee earned $1,200, but actually receives $910 after deductions. This example shows the difference between gross pay and net pay very clearly. Now let us understand why deductions are made. Some deductions are required by law. For example, income tax may need to be deducted and paid to the government. Some deductions may be required for benefit contributions. Some deductions may be for a pension scheme. Some deductions may be for other agreed items, such as loan repayments or other authorized deductions. The important point is this: the employer must not simply guess deductions. Payroll deductions must be calculated correctly and supported by proper rules and records. If the employer deducts too much, the employee receives less than they should. If the employer deducts too little, the government or another organization may not receive the correct amount. If the employer deducts an amount and then fails to pay it to the correct authority, the business may break the rules. So payroll deductions must be accurate, controlled, and properly recorded. Lesson 5.1, Income tax, tax deducted at source. Now let us move to Lesson 5.1, The name of this lesson is income tax, tax deducted at source. This is one of the most important payroll deductions. Income tax is tax on income earned by a person. When employees earn wages or salaries, the government may require tax to be paid on that income. In many payroll systems, the employer deducts the tax before paying the employee. This is called tax deducted at source. Let us explain the phrase carefully. Source means the place where the income comes from. For an employee, the source of income is the employer. So tax deducted at source means the tax is taken from the employee's pay before the employee receives the money. In simple words, the employee does not first receive the full gross pay and then pay the tax separately. Instead, the employer deducts the tax first and pays the employee the remaining net amount. The employer then pays the deducted tax to the tax authority on behalf of the employee. For example, imagine Sarah works for Bright Stationery Store. Sarah's gross pay for the month is $2,000. The payroll department calculates that income tax of $200 must be deducted. Sarah does not receive the full $2,000. The employer deducts $200 for income tax. Sarah receives the remaining amount as part of her net pay. The employer later sends the $200 to the tax authority, so the employer is acting as a tax collector. This is why payroll is connected to the government. The textbook explains that tax deducted at source covers all the employees of an organization. This means the employer must apply the tax system to all employees who are covered by the rules. The employer deducts tax from employees at source and pays it over on their behalf to the tax authorities. This is a legal responsibility. The employer cannot simply say that employees should deal with everything themselves. If the payroll system requires the employer to deduct tax, the employer must calculate, deduct, record, and pay the tax correctly. Now, students, let us connect this to gross pay and net pay. Income tax is deducted from gross pay. It reduces the amount paid to the employee. But the deducted tax is not an expense kept by the business. The business is only collecting it and passing it to the tax authority. So, from the business point of view, the deducted income tax becomes an amount payable to the tax authority until it is paid. Payable means the business owes it. Let us use a clear example. Ahmed earns gross pay of $1,500. Income tax deducted is $150. Other deductions are also taken, but let us focus only on income tax. The employer pays Ahmed less than $1,500 because $150 has been deducted. That $150 must later be paid to the tax authority. The business should not treat it as its own money. It belongs to the tax authority. Now, why is this system useful? It helps the government collect tax regularly. It helps employees because tax is deducted gradually through payroll. It helps the business meet legal payroll responsibilities. But it also creates responsibility for the employer. The employer must use the correct tax information. The employer must deduct the correct amount. The employer must keep proper records. The employer must pay the tax to the correct authority on time. If the employer makes mistakes, there may be problems for the employee, the employer, and the government. Now, students, here is the key exam understanding for Lesson 5 and Lesson 5.1. Payroll deductions are amounts taken from gross pay before net pay is paid to the employee. Income tax is one of the main deductions. Tax deducted at source means the employer deducts income tax from the employee's pay before the employee receives the money. The employer then pays that tax to the tax authority on behalf of the employee. So the big message is this. Gross pay is what the employee earns. Deductions are amounts taken away. Net pay is what the employee receives. Income tax deducted at source is a major payroll deduction, and the employer is responsible for collecting it and paying it to the tax authority correctly. Now we are studying Lesson 5.2. The name of this lesson is Benefit Contributions. In the previous lesson, we learned about income tax deducted at source. We learned that income tax is deducted from an employee's gross pay before the employee receives net pay. Now we are learning about another important payroll deduction. This is called benefit contributions. Benefit contributions are amounts paid into a government or state system to help provide welfare benefits to people. In many countries, employees, employers, or BOEs and employers may be required to make these contributions. The exact name of the contribution may be different from country to country. In one country, it may be called national insurance. In another country, it may be called Social Security. In another country, it may be called employment insurance, health contribution, pension contribution, or another similar name. Do not worry too much about the name. The important accounting idea is the same. The payroll system may deduct certain contributions from employees' pay, and the business may also have to pay an employer contribution. Now let us understand what these contributions are used for. Benefit contributions may help pay for unemployment benefit. Unemployment benefit is support for people who are out of work and meet the rules for receiving help. Benefit contributions may help pay for sickness benefit. Sickness benefit is support for people who cannot work because they are sick. Benefit contributions may help pay for a state pension scheme. A state pension is money paid to people when they reach retirement age, depending on the rules of the country. Benefit contributions may also help pay for a state health service in some countries. A state health service provides medical care or health support to people. So benefit contributions are connected to social welfare and public support. Now students, let us connect this to payroll. Employee benefit contributions are usually deducted from the employee's gross pay. This means the employee earns gross pay first. Then the payroll department deducts income tax, benefit contributions, and other deductions. After this, the employee receives net pay. For example, imagine Sarah has gross pay of $1,000. The payroll department deducts income tax. The payroll department also deducts benefit contributions. After all deductions, Sarah receives her net pay. So employee benefit contributions reduce the amount that the employee actually receives. Now the employer may also have to pay benefit contributions. This is a very important point. Employer benefit contributions are not deducted from the employee's gross pay. They are an additional cost to the employer. Let us explain this carefully. Suppose Ahmed earns gross wages of $2,000. The employee contribution may be deducted from Ahmed's gross pay, but the employer contribution is paid by the business itself. The employer contribution is not taken from Ahmed's pay. It is an extra payroll cost for the business. So there are two possible parts. One part may be paid by the employee through a deduction from gross pay. The other part may be paid by the employer as an additional business expense. This is why payroll is important for both employees and the business. For the employee, contributions reduce net pay. For the employer, contributions increase payroll cost. Now, the textbook explains that the exact contributions and benefits vary from country to country. This means the detailed rules are not the same everywhere. One country may have one type of contribution. Another country may have a different type. The percentage rates may be different. The payment dates may be different. The names may be different. But for your accounting understanding, the main idea is this. Payroll must calculate the correct deductions and employer contributions according to the rules that apply. Now let us explain the employer's role. Just like with income tax, the business often acts as a collector. The employer deducts the employee's benefit contributions from gross pay. Then the employer must pay the collected money to the relevant authority. Relevant authority means the government department or organization responsible for receiving the contribution. The money collected is not the business's own money. The business is only holding it temporarily. Later, it must be paid over. For example, if Bright Stationery Store deducts $100 from employees' pay for benefit contributions, the business must not keep that $100. It must pay it to the correct authority. Now let us look at the total amount sent to the authority. The total amount remitted may include two parts. First, the employee's contribution. This is deducted from the employee's gross pay. Second, The employer's contribution. This is paid by the employer and is an additional cost to the business. So the business may send both amounts together to the authority. Now, students, we must be very clear about the accounting difference. Employee contributions are deductions from gross pay. Employer contributions are additional expenses of the business. This means employer contributions increase the total wages and salaries cost reported by the business. The total cost of wages and salaries in the statement of profit or loss is not only the gross wages. It is gross wages plus the employer's benefit contribution. Let us use a simple example. Bright Stationery Store pays employees gross wages of $10,000 for the month. The employer also has to pay employer benefit contributions of $1,000. The total payroll cost for the business is not only $10,000. The total payroll cost is $11,000. Why? Because the business must pay the gross wages and also pay the employer benefit contribution. So the employer contribution is an extra business cost. Now, students, the key lesson from benefit contributions is this. Benefit contributions may be deducted from employees' gross pay. The employer may also have to make its own contribution. Employee contributions reduce net pay. Employer contributions increase business cost. The business must pay the collected contributions to the correct authority. Lesson 5.3. Pension contributions. Now we move to lesson 5.3. The name of this lesson is pension contributions. A pension is money that provides income for a person after retirement. Retirement means the time when a person stops working, usually later in life. Many employers operate a pension scheme for their employees. A pension scheme is a plan that helps employees save money for retirement. The payroll department has an important role in pension contributions. If employees contribute to a company pension scheme, the payroll department deducts pension contributions from employees' pay. It must also keep proper records of those contributions. It may also need to report the contributions to the pension fund administrators. A pension fund administrator is the organization or group responsible for managing the pension scheme records and funds. Now let us explain how pension contributions work. Pension contributions can come from two main sources. The first source is the employer only. This is called a non-contributory pension scheme. Non-contributory means the employee does not contribute from their own pay. Only the employer contributes. For example, the business may decide to pay pension contributions for employees as part of their employment benefits. The employee receives the benefit, but no pension deduction is taken from the employee's gross pay. The second source is both the employer and the employee. This is called a contributory pension scheme. Contributory means the employee contributes and the employer also contributes. For example, an employee may contribute 5% of their gross pay into the pension scheme. The employer may also contribute 10%. The employee's contribution is deducted from the employee's gross pay. The employer's contribution is an additional expense for the business. Now, students, this is very similar to benefit contributions. Employee pension contributions reduce the employee's net pay. Employer pension contributions increase the business's payroll cost. Let us use a simple example. Sarah has gross salary of $2,000. Her employee pension contribution is $100. This $100 is deducted from Sarah's gross pay, so it reduces the amount Sarah receives as net pay. Now suppose the employer also contributes $200 to Sarah's pension. This $200 is not deducted from Sarah's pay. It is paid by the employer as an extra business cost. So the employee contribution and employer contribution are treated differently. The employee contribution is a deduction from pay. The employer contribution is an additional expense of the business. Now, let us understand why proper records are important. Pension contributions affect employees' future retirement benefits. If the payroll department deducts the wrong amount, the employee's pension record may be wrong. If the payroll department fails to pay the contribution to the pension fund, the employee may lose benefits or the business may face problems. If the records are not clear, it may be difficult to prove what was deducted and paid. So pension contributions must be calculated, recorded, and reported accurately. Now, students, the textbook also mentions that other deductions may appear on a payslip. For example, an employee may repay a season ticket loan or another type of loan through payroll. A season ticket loan is when the employer helps the employee pay for travel in advance, and the employee repays the employer over time from their pay. These deductions are not pension contributions, but they show that payroll may include many different types of deductions. The key point is that any deduction must be authorized and recorded properly. Now let us bring Lesson 5.2 and Lesson 5.3 together. Benefit contributions are connected to state welfare systems, such as unemployment benefit, sickness benefit, state pension, or health service support. Pension contributions are connected to retirement savings through a pension scheme. Both can involve deductions from employees' gross pay. Both may also involve additional employer contributions. Employee contributions reduce net pay. Employer contributions increase the employer's payroll cost. The payroll department must calculate them correctly, keep proper records, and pay or report them to the correct authority or pension administrator. So the big message is this. Payroll deductions are not just numbers taken from pay. They represent real responsibilities. The business must deduct the correct amounts, pay them to the correct place, and keep accurate records. This protects employees, the employer, and the organizations that receive the contributions. Now we are studying Lesson 5.4. This lesson gives us an example of contributions. This example is about pension contributions. Remember, a pension contribution is money paid into a pension scheme to help provide income for employees after retirement. In this example, the company is called Authentic Instruments. Authentic Instruments runs a company pension scheme for all its employees. The company contributes an amount equal to 10% of each employee's gross salary into the pension scheme. Each employee also has to contribute 5% of their own gross salary into the pension scheme. So there are two contributions. The first contribution comes from the employee. The second contribution comes from the employer. The employee contribution is deducted from the employee's gross salary. The employer contribution is an extra cost to the business. This difference is very important. Now the example gives us two employees. The first employee is Horatio Arpsichord. Horatio earns $15,000 per year. The second employee is Letitia Ute. Letitia earns $21,000 per year. The question asks, in a typical month, how much will Horatio and Letitia earn gross? How much will they contribute out of salary to the pension scheme? And how much will Authentic Instruments contribute on their behalf? Let us solve it step by step. First, we calculate the monthly gross salary. For Horatio, the annual salary is $15,000. Because we need a typical month, we divide the annual salary by 12 months. $15,000 divided by 12 months gives $1,250. So Horatio's gross salary for a typical month is $1,250. Now we calculate Horatio's employee pension contribution. The employee contribution is 5% of gross salary. 5% of $1,250 gives $62.50. So Horatio contributes $62.50 from his salary to the pension scheme. This amount is deducted from his gross salary before net pay is calculated. Now we calculate the employer contribution for Horatio. The employer contribution is 10% of gross salary. 10% of $1,250 gives $125. So Authentic Instruments contributes $125 on Horatio's behalf. This amount is not deducted from Horatio's salary. It is an additional cost to the company. Now let us do the same for Letitia. Letitia's annual salary is $21,000. Because we need a typical month, we divide the annual salary by 12 months. $21,000 divided by 12 months gives $1,750. So Letitia's gross salary for a typical month is $1,750. Now we calculate Letitia's employee pension contribution. The employee contribution is 5% of gross salary. 5% of $1,750 gives $87.50. So Letitia contributes $87.50 from her salary to the pension scheme. This amount is deducted from her gross salary before net pay is calculated. Now we calculate the employer contribution for Letitia. The employer contribution is 10% of gross salary. 10% of $1,750 gives $175. So Authentic Instruments contributes $175 on Letitia's behalf. Again, this amount is not deducted from Letitia's salary. It is an extra cost paid by the company. Now let us summarize the answers clearly. Horatio's monthly gross salary is $1,250. Horatio's employee pension contribution is $62.50. Authentic Instruments' employer contribution for Horatio is $125. Letitia's monthly gross salary is $1,750. Letitia's employee pension contribution is $87.50. Authentic Instruments' employer contribution for Letitia is $175. Now, students, let us understand the accounting meaning. The employee contribution reduces the employee's net pay. For Horatio, $62.50 is taken from his gross salary. For Letitia, $87.50 is taken from her gross salary. But the employer contribution does not reduce the employee's pay. The employer contribution is paid by the business. For Horatio, the company pays $125. For Letitia, the company pays $175. This is an additional payroll cost for the employer. So the exam point is this: employee pension contributions are deductions from gross pay. Employer pension contributions are extra expenses of the business. Do not mix them up. The big message of Lesson 5.4 is this: when a question gives annual salary but asks for a monthly contribution, first convert annual salary into monthly gross salary. Then calculate the employee contribution from the employee's gross salary and calculate the employer contribution separately as an additional business cost. Now we're studying Lesson 6 of Chapter 17. The name of this lesson is Payment Methods. In the previous lessons, we learned how payroll is calculated. We studied gross pay, deductions, pension contributions, and net pay. Now we are moving to another important question. After the payroll department calculates the amount to be paid, how does the business actually pay the employee? This is what Lesson 6 is about. In simple words, payment methods are the ways a business pays employees their net pay. Remember, net pay means the amount the employee actually receives after deductions. The employee may have gross pay first, then income tax, benefit contributions, pension contributions, and other deductions are taken away. The remaining amount is the net pay. This is the amount that must be paid to the employee. Now, the textbook explains that, for the employee, the payslip is second in importance only to the actual money received. Let us understand this carefully. The most important thing for the employee is receiving the money. Employees need their pay for rent, food, bills, transport, family expenses, and daily life. But after the money itself, the payslip is very important. Why? Because the payslip explains how the payment was calculated. It shows what the employee earned. It shows what deductions were taken. It shows the final net pay. So the payslip gives the employee evidence and understanding. For example, if an employee expected to receive $1,000 but received only $900, the payslip helps explain the difference. It may show that income tax, benefit contributions, or another deduction was taken from gross pay. Now let us look at the common payment methods. The textbook explains that payments are usually made either by check or, increasingly, by credit transfer. A check is a written instruction to the bank to pay money to the employee. Credit transfer means the money is paid directly from the employer's bank account into the employee's bank account. In modern businesses, credit transfer is very common. It is faster, it is safer, it is easier to record. It reduces the need to handle cash or prepare many checks. For example, if a business has 200 employees, it is much easier to transfer each employee's net pay directly into their bank account than to prepare 200 cash envelopes. Now, students, whichever payment method is used, the payment must be secure and authorized. Secure means protected from theft, error, and fraud. Authorized means approved by the correct person. This is very important because payroll involves large amounts of money. If payroll payments are not controlled, the business may pay the wrong employee, pay the wrong amount, pay a fake employee, or pay without proper approval. So payroll payments need strong controls. The textbook says that paying people who work for a large organization can be costly and time-consuming. This is because payroll may involve many employees, many calculations, many deductions, many pay slips, and many payments. Because of this, payroll processing must satisfy 3 requirements. The first requirement is accuracy. Accuracy means the payroll must be correct. The amount paid to employees should be correct, even down to the smallest unit of money. If an employee should receive $1,000, the business should not pay $990 or $1,010. The payroll department must calculate gross pay, deductions, and net pay carefully. Accuracy matters because employees must be paid what they are owed. The government must receive the correct tax and benefit contributions. The business must record payroll costs correctly. The second requirement is timeliness. Timeliness means employees must be paid on time. If employees are paid monthly, they expect to be paid on the correct payday. If employees are paid weekly, they expect to be paid on the correct day of the week. Late payment can cause serious problems for employees. They may have rent to pay. They may have bills due. They may have family expenses. So payroll must be processed in time for employees to receive their money when expected. The third requirement is security. Security means payroll data and payroll money must be protected. Payroll data is confidential. It may include employee names, pay rates, bank details, tax information, deductions, and net pay. Only authorized people should see this information. Security also means the cash, check, or bank payment must be protected from theft or fraud. For example, if a business pays by bank transfer, the payment file must be checked. The employee bank details must be correct. The payment must be approved before it is sent. Now, the textbook explains that payroll payments should be controlled by strict procedures, just like any other payment. A business should not simply calculate payroll and pay it without checking. Before payment is authorized, there should be a correct level of authorization. This means the payment should be approved by someone with authority. For example, the payroll department may prepare the payroll. Then a manager or accountant may review and authorize the payment before money is sent to employees. This separation is important. One person should not have full control over preparing and approving payroll payments alone. The textbook gives 2 specific control elements. The first control is a reconciliation of the payroll system to both the bank statement and the general ledger. Let us explain this simply. After payroll is paid, the business should check that the payroll system agrees with the bank statement. For example, if the payroll system says total net pay of $25,000 was paid, the bank statement should show that $25,000 left the bank account. The business should also check that payroll agrees with the general ledger. The general ledger is the main accounting record. It should show the correct payroll expense, deductions payable, and bank payment. This reconciliation helps find errors. For example, if the payroll system shows $25,000, but the bank statement shows $26,000, there may be a mistake or unauthorized payment. The second control is having different staff members responsible for preparing the payroll and authorizing the payment. This is called separation of duties. One person prepares the payroll. Another person checks and authorizes the payment. This reduces the risk of error and fraud. For example, if the same person could add an employee, calculate payroll, approve payment, and send the bank transfer, that person would have too much control. They might make a mistake or even create a fake payment. But when different people are involved, the work of one person is checked by another person. Now, the textbook also explains that staff involved in processing payroll must complete checking procedures to ensure the accuracy of payroll data. This means payroll staff must check the documents before payment is made. For example, they should check timesheets, attendance records, pay rates, salary changes, deductions, and authorizations. Payroll transactions should be substantiated, verified, and authorized. Substantiated means supported by evidence. Verified means checked for correctness. Authorized means approved by the proper person. For example, overtime pay should be supported by an approved timesheet. A salary increase should be supported by an instruction from the personnel department. A bank payment should be approved by an authorized signatory. The textbook says control procedures should be based on three things. The first is documentation. Payroll documents should be accurate and up to date. These documents may include personnel records, timesheets, attendance records, and payslips. If the documents are wrong, the payroll will probably be wrong. The second is authorization. All payments should be authorized by an appropriate person within adequate financial authorization limits. This means the person approving payroll must have permission to approve that amount. For example, a junior employee may not be allowed to authorize a large payroll payment. A manager or accountant may need to approve it. The third is authorized signatories. Authorized signatories should be recorded, verifiable, and up to date. A signatory is a person allowed to approve or sign payment instructions. The business should know who is allowed to approve payroll payments. If someone leaves the business, their authority should be removed. If a new manager is appointed, their authority should be recorded properly. Now let us look at what can happen if payroll controls are weak. Weak payroll controls can result in inaccurate payroll records and calculations. For example, hours worked may be wrong, pay rates may be wrong, or deductions may be calculated incorrectly. Weak controls can result in payment for work not performed. For example, an employee may claim hours they did not work, or a fake employee may be paid. Weak controls can result in overpayment or underpayment. Overpayment means the employee receives too much. Underpayment means the employee receives too little. Both are problems. Weak controls can result in deductions or benefits being incorrectly calculated. For example, income tax, benefit contributions, or pension deductions may be wrong. Weak controls can result in penalties imposed by tax or other statutory authorities. This means the business may be fined or punished if it does not follow payroll rules. Weak controls can result in a demoralized workforce. Demoralized means employees lose confidence, motivation, and trust. If employees are paid late or incorrectly, they may become unhappy and less motivated. Weak controls can also result in fraud. Fraud means deliberate dishonesty for personal gain. For example, someone may create a fake employee, change bank details without approval, or claim false overtime. Now let us talk about the payslip. For employees, the payslip is an important document and source of information. All employees have a legal right to a payslip. A payslip must show certain basic information. It must show the employee's gross pay. It must show deductions from gross pay and what those deductions are. It must show net pay. These three things are very important. Gross pay shows what the employee earned before deductions. Deductions show what was taken away and why. Net pay shows what the employee actually receives. Now, the textbook also explains that a typical payslip may contain other details. Some details are compulsory unless they are grouped into fixed deductions. These may include the employer's name, the employee's name, gross pay, showing how it is made up, additions to pay and deductions from pay, employer pension contributions, if any, sick pay, if any, maternity pay, if any, tax paid to date in the current tax year, tax in the period, Social Security for the period, net pay, the method of payment for each segment of net pay if the employee is paid in different ways. Other details may not be compulsory, but they are usually shown. These may include the employee's tax code, benefit contributions to date in the current tax year, the employee's payroll number, the employee's national insurance number or equivalent number, the method of payment. The textbook also explains that there is no standard appearance for a payslip. This means different businesses may design payslips differently. One company's payslip may look different from another company's payslip. Some payslips are produced manually. Some payslips are produced by computer. In some payroll systems, the payslip is only one of several computer-generated payroll reports. But whatever the layout looks like, the purpose is the same. The payslip explains the employee's pay. Now, students, let us bring Lesson 6 together. Payment methods are about how employees receive their net pay. Employees may be paid by check or by credit transfer. Payments must be accurate, on time, secure, and authorized. Payroll payments should be supported by documents, checked against records, and approved by the correct person. The payroll system should be reconciled to the bank statement and the general ledger. The person preparing payroll should not be the same person who authorizes the payment. Payslips are important because they show gross pay, deductions, and net pay. So the big message of Lesson 6 is this. Payroll payment is not just sending money to employees. It is a controlled process. The business must pay the correct employee, the correct amount, at the correct time, using a secure and authorized method, and the employee must receive a payslip that explains the payment clearly. Now we are studying Lesson 6.1. The name of this lesson is Cash Payments. In Lesson 6, we learned that employees may be paid by different methods. They may be paid by check, by credit transfer, or in some cases by cash. Now, Lesson 6.1 focuses only on cash payments. Cash payment means the employee receives physical money, such as notes and coins, as their net pay. Remember, net pay means the amount the employee actually receives after deductions. For example, if an employee's gross pay is $1,000 and deductions are $200, the employee's net pay is $800. If the business pays this amount using notes and coins, that is a cash payment. In the past, cash payments were more common. Many employees used to receive wages in cash, often inside a wage packet or pay envelope. But today, cash payments have reduced a lot. The textbook gives two main reasons. The first reason is security problems. The second reason is extra time and effort compared with other payment methods. Let us explain both reasons clearly. First, cash creates security problems. Cash can be stolen. If a business pays many employees in cash, it may need to hold a large amount of money on payday. This creates risk. For example, imagine a company has 100 employees, and each employee must receive $500 in cash. The business needs $50,000 in physical cash. That is a large amount of money to keep in the office. It must be collected from the bank, transported safely, stored safely, counted carefully, placed into pay packets, and handed to the correct employees. At every stage, there is a risk of theft, loss, error, or fraud. This is why many businesses prefer bank transfer. Bank transfer is usually safer because the money goes directly from the business bank account to the employee bank account. Second, cash payments take extra time and effort. If employees are paid by cash, the payroll department must count the money carefully. They must prepare the correct amount for each employee. They must make sure each pay packet contains the correct notes and coins. This can take a lot of time, especially if there are many employees. For example, if one employee must receive $999.31, the payroll team must prepare the exact amount using notes and coins. That is much slower than sending the same amount by bank transfer. Now let us look at why employers have mostly moved away from cash payments. The first reason is that counting notes and coins is time-consuming. Time-consuming means it takes a long time. Preparing cash wages may require more payroll staff than paying by check or bank transfer. For example, one person may need to count the notes, another person may check the amount, another person may put money into envelopes, and another person may record who has been paid. This makes the payroll process slower and more expensive. The second reason is that employees must count their pay and sign for the amount received. When employees receive cash, they need to check that the amount is correct. Then they may need to sign a record to confirm that they received the money. This can cause long queues on payday. For example, imagine many employees waiting outside the payroll office on Friday afternoon to receive their wages. Each employee must collect the cash, count it, ask questions if there is a difference, and sign for it. This can waste time for both employees and payroll staff. The third reason is that the business must work out the exact cash needed before ordering money from the bank. This is an important practical point. The payroll department cannot simply ask the bank for a general amount of cash. It must know how many notes and coins are needed. For example, the business may need a certain number of $50 notes, $20 notes, $10 notes, $5 notes, and coins. This is called making up the payroll cash. The payroll department must calculate the exact cash requirement before payday so the bank can provide the correct mix of notes and coins. If the business orders too little cash, it cannot pay all employees correctly. If it orders too much cash, the business is holding unnecessary money and increasing security risk. The fourth reason is that handling and transporting large amounts of cash creates security problems every payday. If the business collects cash from the bank, someone must carry it to the workplace. That person may need security protection. The cash must be kept safe before payment. During payment, the cash must be controlled carefully. After payment, any remaining cash must be checked and stored safely. This is risky and inconvenient. That is why many businesses prefer to avoid cash payments. Now, students, even though cash payments have reduced, they can still happen in some cases. The textbook explains that cash payment may still occur for part-time employees, temporary staff, and casual staff. Part-time employees work fewer hours than full-time employees. Temporary staff are employed for a short period. Casual staff may work only when needed, often without regular hours. Some businesses may still pay these workers in cash, especially if the work is short-term or occasional. For example, a business may hire casual workers for one day to help with an event. The business may decide to pay them cash at the end of the day. However, even if employees are paid in cash, the business still needs proper payroll records. Cash payment does not mean no records. The business must still calculate gross pay, deductions, and net pay. The business must still prepare pay slips where required. The business must still record the payment in the accounting system. The business must still make sure deductions are paid to the correct authority. The business must still get evidence that the employee received the money. Now let us use one simple example. Bright Stationery Store hires 2 casual workers for a weekend stock count. Each worker is owed $150 net pay. The business decides to pay them in cash. The payroll department must prepare exactly $150 for each worker. Each worker should receive the correct amount. Each worker may sign to confirm receipt. The business must record the payment in the payroll records and accounting records. If tax or other deductions apply, those must also be recorded correctly. So even though the payment is made in cash, it still needs control. Now, students, the key exam understanding is this. Cash payments have become less common because they are risky and time-consuming. They create security problems. They require notes and coins to be counted. They require employees to collect, count, and sign for their pay. They require the business to order the correct amount of cash from the bank. They create risk when cash is transported and stored. Cash payments may still be used for some part-time, temporary, or casual staff, but they must still be properly authorized, recorded, and controlled. So the big message of Lesson 6.1 is this. Cash payment is a possible method of paying employees, but it is usually less efficient and less secure than modern methods such as bank transfer. If a business pays wages in cash, it must use strong controls to protect the money, pay the correct employees, and keep accurate payroll records. Now we are studying Lesson 6.2. The name of this lesson is Ordering Money. This lesson continues from cash payments. In Lesson 6.1, we learned that cash payments are less common today because they are time-consuming and create security problems. But sometimes a business may still pay wages in cash. When this happens, the business must prepare carefully before payday. Lesson 6.2 explains one very practical point. If employees are going to be paid in cash, the business must work out exactly how much cash is needed before going to the bank. The business cannot simply say, "We need some money for wages." The payroll department must know the exact notes and coins required. For example, it may need $50 notes, $20 notes, $10 notes, $5 notes, $2 coins, $1 coins, and smaller coins. The exact denominations depend on the currency used in the country. This process is called preparing a coinage analysis. A coinage analysis is a schedule that shows how many notes and coins are needed to pay each employee the correct net pay. Remember, net pay means the amount the employee actually receives after all deductions. So if an employee's net pay is $156.98, the payroll department must prepare exactly $156.98 for that employee. Now let us explain why this is necessary. If the business is paying by bank transfer, the bank can transfer the exact net pay amount electronically. But if the business is paying by cash, the exact notes and coins must be physically prepared. For example, if one employee is owed $156.98, the payroll department must decide which combination of notes and coins will make that amount. The textbook gives a simple example of an employee whose net pay is $156.98. The amount can be made up like this. $50 notes, 2 gives $100. $20 notes, 2 gives $40. $10 notes, 1 gives $10. $5 notes, 1 gives $5. $1 coin, 1 gives $1. 50-cent coin, 1 gives 50 cents. 20-cent coin, 1 gives 20 cents. 10-cent coins, 2 gives 20 cents. 5-cent coin, 1 gives 5 cents. 2-cent coin, 1 gives 2 cents. 1-cent coin, 1 gives 1 cent. Now, when we add all of these together, the total is $156.98. This is the exact net pay for that employee. The employee would then count the money and sign to confirm that it was received. This signature is important because it gives the business evidence that the employee received the wages. Now, students, imagine this process for only one employee. It already takes time. Now imagine doing it for 10 employees, or 50 employees, or 500 employees. The payroll department must work out the exact cash for every person. This is why cash wages can be slow, difficult, and expensive to administer. The textbook also shows a larger coinage analysis for a business called Monarch Builders. In a coinage analysis, each employee's net wage is listed. Then the payroll department works out how many notes and coins are needed for each employee. At the bottom, the payroll department totals each column. For example, it totals how many $50 notes are needed for all employees. It totals how many $20 notes are needed. It totals how many $10 notes are needed. It totals how many coins are needed. This final total tells the business what to order from the bank. So instead of guessing, the business gives the bank a detailed request. For example, the business may need a certain number of $50 notes, a certain number of $20 notes, a certain number of $10 notes, and so on. This is much more accurate. Now let us understand the control point. The payroll department must prepare the coinage analysis before the cash is collected from the bank. Then the bank can provide the correct notes and coins. After the cash is received, the payroll department must make up each employee's wage packet. A wage packet is an envelope or packet containing the employee's net pay in cash. The employee's name and pay details may be written or printed on the packet. The employee then collects the wage packet, counts the money, and signs for it. This creates evidence that the payment was made. Now the textbook explains another problem. What happens if an employee cannot collect the wage packet? For example, the employee may be ill. In that situation, the unclaimed wage packet should be kept safely until it is collected. If the employee wants someone else to collect the wages, the employee should send written authority naming the person who is allowed to collect the wages. This is an important control. The payroll department should not just give an employee's wages to anyone who asks for them. Why? Because cash can be stolen easily. The business must protect the employee's money. So if another person collects the wages, the business should have written permission, and the person collecting should usually sign for the wages. Now, the textbook also mentions petty cash. It is not uncommon for casual workers to be paid out of petty cash. Petty cash is a small amount of cash kept by the business for small payments. But even if a casual worker is paid from petty cash, the business still needs proper records. The payment must be recorded. The employee should sign a petty cash voucher. Any required deductions must still be made. This is very important. Cash payment does not mean informal payment. Cash payment still needs evidence, authorization, and correct payroll records. For example, if a casual worker is paid $80 in cash, the business should not simply hand over the money with no record. There should be a document showing who was paid, how much was paid, why the payment was made, and who authorized it. Now, students, let us connect this lesson to the bigger payroll control system. Ordering money is not just a banking task. It is part of payroll control. The business must know the exact net pay for each employee. The business must prepare the correct notes and coins. The business must collect the correct cash from the bank. The business must keep the cash safe. The business must prepare each wage packet accurately. The business must make sure each employee receives the correct amount. The business must obtain a signature as evidence of payment. The business must protect any unclaimed wages. The business must record all cash payments properly. If these controls are weak, many problems can happen. An employee may be paid the wrong amount. Cash may be stolen. A wage packet may be given to the wrong person. Unclaimed wages may disappear. Payroll records may not agree with the cash withdrawn from the bank. The business may not be able to prove that the employee was paid. So this lesson is very practical. Now let us finish with the key exam understanding. If wages are paid in cash, the payroll department must prepare a coinage analysis. A coinage analysis shows the exact notes and coins needed for each employee's net pay. The totals from the coinage analysis are used to order money from the bank. Employees should count and sign for the wages they receive. Unclaimed wage packets must be kept safely. If someone else collects wages for an employee, written authority should be required. Casual workers may sometimes be paid from petty cash, but proper records and deductions are still necessary. The big message of Lesson 6.2 is this. Ordering money is about preparing the exact cash needed for wage payments. It requires careful calculation, proper documentation, safe handling of cash, and evidence that each employee received the correct net pay. Now we are going to explain how employees can be paid using check and bank payment. In the previous lesson, we learned about cash payments. Cash payments are possible, but they can be risky, slow, and expensive to manage. Because of this, many businesses prefer to pay employees without using physical cash. The two main non-cash methods are paying by check, paying by bank payment, usually by credit transfer. Let us explain both methods carefully. Paying payroll by check. A check is a written instruction to the bank to pay money from the employer's bank account to the employee. In payroll, the check will usually show the employee's name and the amount of net pay. Remember, Net pay means the amount the employee actually receives after deductions. For example, if an employee's gross pay is $1,000 and total deductions are $200, the net pay is $800. If the business pays by check, the check should be written for $800. The employee then takes the check to the bank or deposits it into their bank account. Now, paying by check is simpler than paying by cash in some ways. The business does not need to collect large amounts of notes and coins from the bank. The business does not need to prepare wage packets. The business does not need to count exact coins for every employee. This reduces some of the security problems of cash payment. However, check payments still take time. If a business has many employees, writing checks for all employees can be a lot of work. For example, if a company has 1,000 employees, it may need to prepare 1,000 checks. Each check must show the correct employee name and the correct net pay. The checks may also need to be signed or authorized. This can take a long time. The textbook explains that some of the effort can be reduced if checks are printed beforehand. This means the payroll system may prepare the check details automatically, so only the signature is still required. In some businesses, the check may be attached to a perforated payslip. Perforated means the paper has a line that allows one part to be torn off easily. The payslip is at the top and the check is at the bottom. The employee receives both together. The employee tears off the check and takes it to the bank. This method is a control because the check must be numbered in sequence and it must be kept under strict control. Now, students, why must checks be controlled carefully? Because checks are valuable documents. If blank checks are stolen, someone may try to use them fraudulently. If check numbers are not controlled, a missing check may not be noticed. If checks are signed without checking, the business may pay the wrong amount or the wrong person. So check payments must be authorized and recorded carefully. There should be a record of check numbers. There should be a check that each check agrees with the payroll records. There should be proper signatures. There should be separation of duties, so the person preparing the payroll is not the only person approving the payment. Now let us use a simple example. Imagine Bright Stationery Store pays an employee called Sarah by check. Sarah's gross pay is $1,200. Her deductions are $250. Her net pay is $950. The payroll department prepares a payslip showing gross pay, deductions, and net pay. Then a check is prepared for $950. The check is made payable to Sarah. An authorized person signs the check. Sarah receives the payslip and the check. Sarah deposits the check into her bank account. This is payroll payment by check. Now let us move to bank payment. Paying payroll by bank payment. Bank payment usually means paying employees by credit transfer. A credit transfer means money is transferred directly from the employer's bank account to the employee's bank account. This is now one of the most common payroll payment methods. It is faster than cash. It is safer than cash. It is more efficient than writing many checks. It is easier to record and reconcile. In modern payroll systems, the payroll department prepares a payment file. This file contains the employee payment details. The file is sent to the bank, and the bank transfers the money to employees' accounts. The textbook explains that the payroll department prepares the payroll on magnetic disk or tape and sends it to the automated service run by the clearing banks. Today, this would usually mean an electronic payroll file or online banking payment file. The technology has changed, but the idea is the same. The payroll system prepares the payment information. The bank receives the information. The bank transfers the money from the employer's bank account to employees' bank accounts. This system is called an automated payment system. It replaces the need to fill wage packets with cash or prepare large numbers of checks. Now let us understand what information the employer must send to the bank. The employer normally sends the employee's full name. The employer sends the exact amount to be paid, which is the net pay shown on the payslip. The employer sends the bank and branch number, or the bank account identification information used in that country. The employer sends the employee's bank account number. These details are essential. If the employee's bank account number is wrong, the money may go to the wrong account. If the amount is wrong, the employee may be overpaid or underpaid. If the employee name does not match the payment details, there may be a payment problem. So payroll bank payment must be checked very carefully. Now, students, the textbook also explains that the bank may need the information 2 or 3 days before payment is made. This means the payroll department cannot leave everything until the last minute. The payroll must be prepared early enough so that employees receive their pay on the correct payday. This connects to the idea of timeliness. Employees must be paid on time. If the payroll file is sent late, employees may receive their pay late. That can cause serious problems for employees and damage trust in the employer. Now let us use a simple example. Bright Stationery Store has 3 employees. Sarah's net pay is $1,000. Ahmed's net pay is $1,200. Maria's net pay is $2,000. The payroll department prepares the payroll. It checks gross pay, deductions, and net pay. It prepares pay slips for each employee. Then it prepares a bank payment file showing each employee's name, bank account details, and net pay amount. The file is reviewed and authorized by the correct person. Then the file is sent to the bank. On payday, the bank transfers the money directly into each employee's bank account. Sarah receives $1,000. Ahmed receives $1,200. Maria receives $2,000. This is payroll payment by bank transfer. Now, students, bank payment also needs strong control. The payroll payment file should be checked before it is sent. The total of all net wages should be agreed to the payroll records. The payment should be authorized by an appropriate person. Employee bank details should be kept secure. Changes to bank details should be supported by proper evidence and authorization. After payment, the payroll system should be reconciled with the bank statement and the general ledger. Let us explain reconciliation here. Suppose the payroll system says that total net pay is $50,000. The bank statement should show that $50,000 was paid out for payroll. The general ledger should also show the correct payroll payment. If the bank statement shows a different amount, the business must investigate. Maybe one employee was paid twice. Maybe a payment failed. Maybe the payroll file contained an error. Maybe an unauthorized payment was made. This is why reconciliation is an important control. Now let us compare check and bank payment. Check payment is less risky than cash because the business does not need to handle large amounts of physical money. But check payment can still take time because each check must be prepared, checked, signed, and controlled. Bank payment is usually faster and more efficient because money goes directly from the employer's bank account to the employee's bank account. Bank payment is especially useful when a business has many employees. However, bank payment also needs strong controls because mistakes in bank details or payment files can cause serious problems. Now let us also mention exceptional check payments. The textbook explains that even though check payments are becoming less common, they may still be used for special circumstances. For example, an employee may leave partway through the month. A new employee may join during the month. An employee may receive an advance of salary. In these cases, the business may need to make a separate payment outside the normal automated payroll run. A check may still be used for this type of special payment. But even special payments must be authorized, recorded, and supported by proper documents. Now, students, here is the key exam understanding. Paying by check means the employer gives the employee a check for the net pay. The check must show the correct employee and amount. Checks must be controlled because they are valuable documents. Paying by bank payment means the employer transfers net pay directly into the employee's bank account. The employer sends the bank employee names, net pay amounts, and bank account details. Bank payment is faster and more efficient for large payrolls. Both check and bank payment must be authorized, recorded, checked, and reconciled. The big message is this: payroll payment is not complete when net pay is calculated. The business must also pay the employee using a safe and controlled method. Checks reduce the need for cash, but still require careful preparation and control. Bank payments are usually more efficient, but they require accurate bank details, proper authorization, secure processing, and reconciliation with the bank statement and general ledger. Now we are studying Lesson 7 of Chapter 17. The name of this lesson is Updating Records. This lesson is very important because payroll does not finish when employees are paid. Many students think payroll ends when the employee receives their money. But in accounting, that is not enough. After employees have been paid, the business must update its records. This means the business must keep accurate, complete, and up-to-date records of employees and the payroll transactions connected with them. In simple words, after payroll is processed and paid, the business must record what happened, who was paid, how much gross pay was earned, what deductions were taken, what net pay was paid, what employer contributions were made, what amounts are still payable to outside organizations, which department should the payroll cost belong to. All of this information must be recorded properly. Now let us understand the main idea. The textbook says it is vitally important for businesses to keep accurate and up-to-date records on employees and the financial transactions relating to them. Vitally important means extremely important. Why? Because payroll affects many people and many accounts. It affects employees because their pay, deductions, and pension records must be correct. It affects the employer because wages and salaries are a major cost. It affects the government because tax and benefit contributions must be paid correctly. It affects pension funds because pension contributions must be recorded accurately. It affects accounting records because payroll must be included in the general ledger. So payroll records must not be careless, late, or incomplete. Now let us explain what happens after employees are paid. Once employees have been paid, a record of each payment must be maintained on a cumulative basis. Cumulative basis means the record builds up over time. For example, the business does not only record 1 month and then forget it. It keeps totals from period to period. It may show what the employee earned this month. It may also show what the employee has earned so far this year. It may show tax deducted this month. It may also show tax deducted so far this year. This is useful because payroll information is often needed for tax returns, employee records, pension records, management reports, and year-end reporting. Now let us look at why payroll records are needed. The first reason is to explain labor cost. Labor cost means the cost of employees to the business. This includes gross pay and employer contributions. Gross pay is the employee's total pay before deductions. Employer contributions are extra amounts paid by the employer, such as employer benefit contributions or employer pension contributions. These employer contributions are not deducted from the employee's pay. They are additional costs to the business. So to understand the true cost of employing staff, the business must record both gross pay and employer contributions. For example, imagine Bright Stationery Store pays an employee gross wages of $2,000 for the month. The employer also pays employer benefit contributions of $200. The total labor cost to the business is not only $2,000. The total labor cost is $2,200. So records of gross pay and employer contributions help explain how total labor cost is made up. The second reason is to allocate employee costs to the correct departments. Allocate means place the cost in the correct area. Many businesses have different departments. For example, a business may have a sales department, warehouse department, administration department, and production department. If an employee works in the warehouse, their wages should be charged to the warehouse department. If an employee works in sales, their wages should be charged to the sales department. If an employee works in administration, their salary should be charged to administration. This is important because management wants to know how much each department costs. For example, if the production department has very high labor costs, management may want to investigate why. If the sales department has increasing commission costs, management may want to compare that with sales revenue. So individual employee records help the business allocate labor costs correctly. Now let us look at pension records. If an employer operates an occupational pension scheme, records of pension contributions must be maintained. An occupational pension scheme is a pension scheme connected to employment. Employees may contribute part of their pay to the pension scheme. The employer may also contribute additional amounts. These records are very important because employees' future benefits may depend on them. Let us explain that carefully. A pension is not only about today. It is about the employee's future retirement income. If pension records are wrong today, the employee may suffer many years later. For example, if the payroll department deducts pension contributions but does not record them correctly, the pension fund may not show the correct amount. This could affect the employee's future pension benefits. That is why bad record keeping now can have a negative effect in the future. So pension contribution records must be accurate, complete, and properly maintained. Now let us look at employee loans. Sometimes an employee may borrow money from the employer. For example, the employer may give an employee a season ticket loan for travel or another type of staff loan. The employee then repays the loan through payroll deductions over time. In this case, the payroll records must show each repayment. Why? Because both the employer and employee need to know how much has been repaid and how much is still outstanding. Outstanding means still unpaid. For example, suppose an employee borrows $1,000 from the employer. Each month, $100 is deducted from the employee's pay to repay the loan. The payroll record must show each $100 repayment. After 10 months, the loan should be fully repaid. If the records are not updated, the employee may continue to be deducted after the loan has already been paid off. That would be unfair and incorrect. So employee loan repayments must be recorded carefully. Now the textbook also explains that employee records should contain much the same data as found on the payslip. This makes sense because the payslip is the employee's summary of pay for the period. The payroll records should support and agree with the payslip. For example, the records may show basic pay, overtime, gross pay, income tax, benefit contributions, pension contributions, other deductions, and net pay. If the payslip shows one amount but the payroll record shows a different amount, there is a problem. The records should agree. Now let us talk about reconciliation. The business should ensure there is a reconciliation between gross pay as calculated and net pay as paid. Reconciliation means comparing two records to make sure they agree. In payroll, the business must check that the gross pay calculation, deductions, and net payment all connect properly. The basic idea is this: gross pay minus deductions gives net pay. If gross pay was calculated as $1,000 and deductions were $200, net pay should be $800. If the bank payment shows a different amount, the business must investigate. Maybe a deduction was missed. Maybe the wrong net pay was paid. Maybe there was a bank error. Maybe the payroll record was updated incorrectly. This is why reconciliation is an important control. Now, the textbook explains that this payroll information may be documented in a wages analysis book in manual systems. Manual systems mean systems where records are written or prepared by hand or not fully computerized. A wages analysis book is a payroll record used to summarize wages, deductions, net pay, and related payroll information. It may show each employee's gross pay, income tax, benefit contributions, pension contributions, other deductions, and net pay. It may also show totals for the whole payroll period. For example, a wages analysis book can show the total gross pay for all employees in the week, the total deductions, and the total net pay. This helps the accountant record payroll correctly. Now, students, even if a business uses a computerized payroll system, the same idea still applies. The system must keep proper records. It must store employee information. It must store payroll calculations. It must keep records of payments and deductions. It must produce reports for management, employees, and external authorities. The textbook explains that accounting records must also be updated. This is a very important point. Payroll records are not separate from accounting. Payroll affects the accounting system. When employees are paid, the business must update the general ledger. For example, wages and salaries are recorded as an expense. Income tax deducted from employees may be recorded as a liability until it is paid to the tax authority. Benefit contributions may be recorded as a liability until they are paid to the correct authority. Pension contributions may be recorded as a liability until they are paid to the pension fund. Bank is reduced when employees receive their net pay. So payroll affects expenses, liabilities, and bank. The records must be updated correctly so that the financial statements are accurate. Now, the textbook also says that in an integrated computerized accounting system, these updates may be automated. Integrated means the payroll system and accounting system are connected. For example, once payroll is processed, the system may automatically update the payroll records, the employee records, the general ledger accounts, and the bank payment information. This reduces the volume of work. Volume of work means the amount of work that staff must do. It also reduces the possibility of errors. Why? Because when information is entered manually, many times, mistakes can happen. For example, one person may enter the net pay correctly in the payroll system, but enter it incorrectly in the accounting system. A computerized integrated system reduces this risk because the same data can be used automatically in different parts of the system. But students, remember this. Even if the system is computerized, controls are still needed. The payroll data must still be checked. Employee details must still be correct. Pay rates must still be authorized. Deductions must still be accurate. Bank details must still be protected. So computerization helps, but it does not remove the need for control. Now let us use a simple example to bring the lesson together. Imagine Bright Stationery Store has 3 employees. Sarah earns gross pay of $2,000. Ahmed earns gross pay of $1,800. Maria earns gross pay of $3,000. The payroll department calculates deductions for each employee. It pays each employee their net pay by bank transfer. Now the work is not finished. The payroll department must update Sarah's record, Ahmed's record, and Maria's record. It must record their gross pay, deductions, and net pay. It must record any pension contributions. It must record any loan repayments. It must update cumulative totals for the year. The accounting department must also update the general ledger. It records wages and salaries expense. It records amounts owed to tax authorities. It records amounts owed to pension funds. It records the bank payment. Then the business checks that the payroll records agree with the bank statement and the accounting records. That is the purpose of updating records. Now, students, the key exam understanding is this. Payroll does not end when employees are paid. After payment, the business must maintain accurate records for employees and payroll transactions. Records must be kept on a cumulative basis. Payroll records explain labor costs. Payroll records help allocate costs to the correct departments. Pension contribution records protect employees' future benefits. Loan repayment records show when employee loans have been repaid. Employee records should agree with pay slips. Gross pay calculated should reconcile with net pay paid. Accounting records must be updated after payroll. Computerized systems can reduce work and errors, but proper controls are still necessary. So the big message of Lesson 7 is this. Updating records is the final control stage of payroll. It makes sure that employee records, payroll records, and accounting records are accurate, complete, and up to date. Without proper record updating, employees may be paid incorrectly, deductions may be wrong, liabilities may be misstated, and the financial records of the business may become unreliable. Now we are studying Lesson 7.1. The name of this lesson is Payroll Ledger Accounts. In Lesson 7, we learned that after employees have been paid, the business must update the payroll records and the accounting records. Now, Lesson 7.1 focuses on the ledger accounts used to record payroll. This is very important because payroll is not only a payment to employees. Payroll creates expenses, deductions, liabilities, and bank payments. All of these must be recorded in the correct ledger accounts. Let us begin with the main idea. Entering payroll data into the correct ledger accounts is normally quite straightforward. Straightforward means it usually follows a regular pattern. Why? Because payroll is usually done at regular intervals. A business may process payroll weekly. A business may process payroll monthly. Some businesses may process payroll every 2 weeks. But the important point is that payroll happens regularly, and the same types of entries usually happen every pay period. For example, every month the business may record gross wages. Every month the business may record deductions for income tax. Every month the business may record deductions for employee benefit contributions. Every month the business may record pension deductions. Every month the business may pay net wages to employees. Every month the business may record employer contributions. So the entries are repeated again and again. This makes payroll ledger accounting easier once you understand the pattern. Now, students, the most important account in this lesson is the Wages General Ledger account. The Wages General Ledger account is used as a central account for payroll entries. You can think of it as a payroll clearing account. A clearing account is an account used to collect entries temporarily so that they can be checked and cleared to the correct accounts. In payroll, the Wages General Ledger account helps the accountant make sure that the payroll entries have been recorded correctly. At the end, after all payroll entries have been posted, the Wages General Ledger account should normally have a nil balance. Nil balance means no balance remains. Why should it become nil? Because everything inside it should be transferred to the correct place. The gross wages should become staff cost. The net wages should be paid through the bank. The income tax deduction should become an income tax liability. The employee benefit contribution deduction should become a benefit contribution liability. The pension deduction should become a pension fund liability. The employer contributions should become staff cost and liability accounts. So, after all these entries are posted, the Wages General Ledger account should be cleared. Now let us understand the main accounts used in payroll. The first account is the staff costs account. The staff costs account records the cost of employing workers. This includes gross wages and salaries. It may also include employer benefit contributions and employer pension contributions. These are expenses of the business. For example, if employees earn gross wages, the business records this as a staff cost because it is the cost of labor used by the business. The second account is the Wages General Ledger account. This account collects payroll entries and helps check that all payroll amounts have been posted correctly. It is not meant to keep a final balance after everything has been recorded. It should be cleared when the payroll entries are complete. The third account is the bank account. The bank account records the actual money paid to employees. Employees do not receive gross pay. They receive net pay. So the amount paid from the bank is normally the net wages or net salaries. For example, if employees earn gross wages of $31,200, but deductions are taken away, the bank may only pay $25,000 as net pay. The fourth account is the income tax liability account. When income tax is deducted from employees' net pay, the business does not keep that money. The business owes it to the tax authority, so it is recorded as a liability until it is paid. A liability means an amount the business owes. The fifth account is the benefit contributions liability account. This account records benefit contributions that must be paid to the relevant authority. There may be employee benefit contributions deducted from employees' gross pay. There may also be employer benefit contributions paid by the business. Both may need to be paid later to the relevant authority. The sixth account is the pension fund liability account. This account records pension contributions that must be paid to the pension fund. There may be employee pension contributions deducted from employees' wages. There may also be employer pension contributions paid by the business. Until these amounts are paid to the pension fund, they are liabilities. Now let us explain the basic payroll flow. First, the business records gross wages. Gross wages are the total earnings of employees before deductions. This creates an expense for the business. So the staff costs account is debited and the wages general ledger account is credited. Let us say this in simple words. The business records the payroll cost as an expense, and at the same time, the wages general ledger account is used to collect the payroll amount. Second, the business records net wages paid to employees. Net wages are the amount actually paid to employees after deductions. When employees are paid, the bank account decreases, so the wages general ledger account is debited and the bank account is credited. In simple words, the payroll amount is cleared from the wages general ledger account and the bank shows the payment made to employees. Third, the business records deductions. Deductions are amounts taken from employees' gross pay. For example, income tax, employee benefit contributions, and employee pension contributions. These deductions are not paid to the employee. They are owed to external agencies, such as the tax authority or pension fund. So the wages general ledger account is debited and the relevant liability account is credited. In simple words, the employee's deduction reduces the amount paid to the employee, but it creates a payable amount to someone else. Fourth, the business records employer contributions. Employer contributions are not deductions from the employee's pay. They are extra costs paid by the business. For example, employer benefit contributions and employer pension contributions. These are added to staff costs because they are part of the total cost of employing staff. So the staff costs account is debited and the relevant liability account is credited. In simple words, employer contributions increase the business expense and create a liability until the business pays the external authority or pension fund. Now students, let us use a simple example without doing the full next example. Imagine Bright Stationery Store processes payroll for the month. Employees earn gross wages. The business deducts income tax and pension contributions. The employees receive net pay by bank transfer. The employer also pays employer pension contributions. In the ledger accounts, the business must record all of these things. Gross wages go to staff costs. Net pay goes to bank. Income tax deducted goes to income tax liability. Pension deducted from employees goes to pension fund liability. Employer pension contribution goes to staff costs and pension fund liability. The wages general ledger account helps connect and check all of these entries. Now here is the most important control point. The wages general ledger account helps ensure the entries are being made correctly. After all wages items have been posted, the balance on the wages general ledger account should be nil. If the wages general ledger account still has a balance, that may mean something has been missed or posted incorrectly. For example, perhaps net pay was not posted. Perhaps a deduction was forgotten. Perhaps employer contributions were recorded wrongly. Perhaps the wrong amount was entered in one account. So the wages general ledger account is useful as a check. It helps the accountant see whether the payroll entries balance properly. Now students, remember that payroll is normally processed weekly or monthly. This means the same types of ledger entries are repeated each pay period. This regular pattern is helpful in the exam. Once you understand the pattern, payroll ledger entries become much easier. For the exam, think like this. Gross wages are a staff cost. Net pay is paid through the bank. Employee deductions become liabilities. Employer contributions are additional staff costs and also become liabilities. The wages general ledger account is used to make sure everything has been posted correctly. So the big message of lesson 7.1 is this: payroll ledger accounts are used to record payroll expenses, employee deductions, employer contributions, net payments to employees, and amounts owed to external organizations. The wages general ledger account acts as a control account for payroll entries, and after all payroll entries have been posted correctly, it should normally have a nil balance. Now we are studying lesson 7.2. This lesson gives us a full example of how payroll is recorded in the general ledger accounts. In lesson 7.1, we learned the basic idea. Payroll does not only affect one account. Payroll affects staff costs, the wages general ledger account, the bank account, tax liability accounts, benefit contribution liability accounts, and pension fund liability accounts. Now, lesson 7.2 shows us how these accounts work together. The business in this example is Comecon Limited. Comecon Limited pays its workers every month. For month 1, the payroll information is as follows. Gross wages are $31,200. Employer benefit contributions are $2,000. Net wages paid to workers by direct credit are $25,000. Income tax deducted from workers' wages is $4,000. Employees' benefit contributions deducted from wages are $1,000. Employees' pension contributions deducted from wages are $1,200. Employer pension contributions are $1,500. The business also has $50,000 in the bank at the beginning of the month. Now, students, before we record anything, let us understand the meaning of each item. Gross wages are the total wages earned by employees before deductions. Net wages are the actual amount paid to employees after deductions. Income tax deducted from workers' wages is money taken from employees' gross wages and owed to the tax authority. Employees' benefit contributions are also deducted from employees' gross wages and owed to the relevant authority. Employees' pension contributions are deducted from employees' wages and owed to the pension fund. Employer benefit contributions are not deducted from employees' pay. They are an extra cost paid by the employer. Employer pension contributions are also not deducted from employees' pay. They are an extra cost paid by the employer. This difference is very important. Employee deductions reduce net pay. Employer contributions increase the business's payroll cost. Now we will record the payroll step by step. Step 1. Record gross wages. The employees have earned gross wages of $31,200. This is a cost to the business. So we debit staff costs with $31,200. At the same time, we credit the wages general ledger account with $31,200. The entry is debit staff costs, gross wages, $31,200. Credit wages general ledger account, $31,200. Why do we debit staff costs? Because wages are an expense of the business. Why do we credit the wages general ledger account? Because the wages general ledger account is being used as a clearing account to collect the payroll entries before they are cleared to the correct places. Step 2. Record employer payroll costs. Now we record the employer's additional costs. The employer has benefit contributions of $2,000. The employer also has pension contributions of $1,500. These are not taken from employees' wages. They are additional costs of employing staff. So we debit staff costs with $2,000 for employer benefit contributions. We also debit staff costs with $1,500 for employer pension contributions. Together, these two employer costs are $3,500. Then we credit the wages general ledger account with $3,500. The entry is debit staff costs, employer benefit contributions, $2,000. Debit staff costs, employer pension contributions, $1,500. Credit wages general ledger account, $3,500. Now the total staff cost for the month is beginning to build up. Gross wages are $31,200. Employer benefit contributions are $2,000. Employer pension contributions are $1,500. So total staff cost is $34,700. This is the full payroll cost to the business for the month. Step 3. Record net wages paid to employees. Now we record the actual payment made to employees. The employees are paid net wages of $25,000 by direct credit. Direct credit means the money is transferred directly from the business bank account to the employees' bank accounts. When employees are paid, the bank account decreases, so we credit bank with $25,000. We also debit the wages general ledger account with $25,000. The entry is debit wages general ledger account, $25,000. Credit bank, net wages paid, $25,000. Why do we debit the wages general ledger account? Because we are clearing part of the amount that was credited earlier. Why do we credit bank? Because money has left the business bank account. Now students, notice something important. Employees earned gross wages of $31,200, but they received only $25,000. Why? Because deductions were taken from their wages. Those deductions have not been paid to employees. They will be owed to other organizations such as the tax authority or pension fund. Step 4. Record income tax deducted from employees. The business deducted income tax of $4,000 from employees' wages. This money is not paid to the employees. It is owed to the tax authority. So we debit the wages general ledger account with $4,000. We credit the income tax liability account with $4,000. The entry is debit wages general ledger account, $4,000. Credit income tax liability account, $4,000. Why do we credit the income tax liability account? Because the business now owes this amount to the tax authority. Until the business pays it, it is a liability. Step 5. Record employees' benefit contributions. The business also deducted employees' benefit contributions of $1,000 from employees' wages. Again, this money is not paid to employees. It is owed to the relevant authority. So we debit the wages general ledger account with $1,000. We credit the benefit contributions liability account with $1,000. The entry is debit wages general ledger account, $1,000. Credit benefit contributions liability account, employees' contributions, $1,000. This records the amount deducted from employees and owed to the authority. Step 6. Record employer benefit contributions. Now we record the employer's benefit contributions. The employer's benefit contributions are $2,000. Remember, this amount is not deducted from employees' pay. It is an extra cost to the employer. We already recorded it as part of staff costs in Step 2. Now we must transfer it from the wages general ledger account into the benefit contributions liability account. So we debit the wages general ledger account with $2,000. We credit the benefit contributions liability account with $2,000. The entry is debit wages general ledger account, $2,000. Credit benefit contributions liability account, employer's contributions, $2,000. Now the benefit contributions liability account includes two parts. Employees' benefit contributions of $1,000, employer benefit contributions of $2,000. So the total benefit contributions liability is $3,000. This amount will be paid later to the relevant authority. Step 7. Record employees' pension contributions. Now we record the employees' pension contributions. Employees' pension contributions are $1,200. This amount is deducted from employees' wages. It is not paid to employees. It is owed to the pension fund. So we debit the wages general ledger account with $1,200. We credit the pension fund liability account with $1,200. The entry is debit wages general ledger account, $1,200. Credit pension fund liability account, employees' contributions, $1,200. This records the employee's pension deduction as a liability owed to the pension fund. Step 8. Record employer pension contributions. Finally, we record the employer's pension contributions. Employer pension contributions are $1,500. This is not deducted from employees' pay. It is an extra cost to the business. We already recorded it as part of staff costs in Step 2. Now we transfer it into the pension fund liability account. So we debit the wages general ledger account with $1,500. We credit the pension fund liability account with $1,500. The entry is debit wages general ledger account, $1,500. Credit pension fund liability account. Employer's contributions, $1,500. Now the pension fund liability account includes two parts. Employees' pension contributions of $1,200. Employer pension contributions of $1,500. So the total pension fund liability is $2,700. This amount will be paid later to the pension fund. Now, students, let us look at what has happened after all entries are posted. The staff costs account has collected the total cost of employing staff for the month. It includes gross wages of $31,200. It includes employer benefit contributions of $2,000. It includes employer pension contributions of $1,500. So the total staff cost is $34,700. This is an expense of the business. It stays in the staff costs account. Next month, the next payroll cost will be added to it. Now let us look at the wages general ledger account. The wages general ledger account was credited with gross wages of $31,200. It was also credited with employer benefit and pension contributions of $3,500. So total credits in the wages general ledger account are $34,700. Now the wages general ledger account was debited with the items that clear the payroll. Net wages paid through bank were $25,000. Income tax liability was $4,000. Employees' benefit contributions liability was $1,000. Employer benefit contributions liability was $2,000. Employees' pension contributions liability was $1,200. Employer pension contributions liability was $1,500. These debits also total $34,700. So the wages general ledger account balances to nil. Nil means there is no balance left. This is exactly what we want. The wages general ledger account is a clearing account. After all payroll items are posted correctly, it should clear to nil. If it does not clear to nil, something may be missing or posted incorrectly. Now let's look at the bank account. The bank account started with $50,000. The business paid employees net wages of $25,000. So the bank balance after paying wages is $25,000. This shows the cash remaining in the bank after the payroll payment. Now let us look at the income tax liability account. The income tax liability account has a credit balance of $4,000. This is the amount deducted from employees' wages and owed to the tax authority. It will be paid later. Now let us look at the benefit contributions liability account. This account has two amounts. Employees' benefit contributions are $1,000. Employer benefit contributions are $2,000. Together, the benefit contributions liability is $3,000. This amount is owed to the relevant authority and will be paid later. Now let us look at the pension fund liability account. This account also has two amounts. Employees' pension contributions are $1,200. Employer pension contributions are $1,500. Together, the pension fund liability is $2,700. This amount is owed to the pension fund and will be paid later. Now, students, after the month end, the business will settle these liabilities. Settle means pay them. The business will pay the income tax liability, the benefit contributions liability, and the pension fund liability. The liabilities are income tax liability, $4,000. Benefit contributions liability, $3,000. Pension fund liability, $2,700. Together, these total $9,700. When the business pays these liabilities, the entry is debit income tax liability, $4,000. Debit benefit contributions liability, $3,000. Debit pension fund liability, $2,700. Credit bank, $9,700. Why do we debit the liability accounts? Because paying them reduces the amounts owed. Why do we credit bank? Because money leaves the bank. After this payment, the liability accounts are cleared. Now let us understand the full payroll picture in simple words. Employees earned wages. The business recorded the cost in staff costs. Employees were paid their net pay through the bank. Tax and other deductions were not paid to employees. They were recorded as liabilities. Employer contributions were added as extra staff costs and also recorded as liabilities. The wages general ledger account was used to check that all payroll entries were complete. When everything was posted, the wages general ledger account had a nil balance. This is the main purpose of the example. Now students, here is the key exam technique. When you see a payroll ledger question, separate the information into 4 groups. First, gross wages and salaries. These are staff costs. Second, net pay. This is paid through the bank. Third, employee deductions. These are liabilities because the business owes them to external agencies. Fourth, employer contributions. These are additional staff costs and also liabilities. If you separate the items like this, payroll ledger entries become much easier. The big message of Lesson 7.2 is this. Payroll accounting is not just one payment. It is a complete system of entries. Gross wages and employer contributions become staff costs. Net pay reduces bank. Employee deductions and employer contributions create liabilities. The wages general ledger account is used as a clearing account, and after all entries are correctly posted, it should have a nil balance. Now we are studying Lesson 7.3. The name of this lesson is Pro Forma Wages General Ledger Account. This lesson is very important because it gives us the standard layout of the wages general ledger account. The word pro forma means a standard format or model layout. So in this lesson, the textbook is showing us what the wages general ledger account normally looks like when payroll entries are posted. In Lesson 7.2, we studied a full payroll example step by step. Now Lesson 7.3 brings the idea together in a general format. The main point is this. The wages general ledger account is used as a clearing account for payroll. A clearing account means an account used temporarily to collect and clear entries. After all payroll entries have been posted correctly, the wages general ledger account should normally have no balance left. In accounting language, we say the balance should be nil. Nil means 0. Now let us understand the 2 sides of the wages general ledger account. One side shows the payroll costs coming into the account. The other side shows how those payroll costs are cleared out to bank and liability accounts. Let us start with the credit side of the wages general ledger account. On the credit side, we normally record staff cost items. These include gross wages. Gross wages are the total wages earned by employees before deductions. For example, before income tax, benefit contributions, pension deductions, and other deductions are taken away, the employee has gross wages. Gross wages are a cost to the business. So the staff costs account is debited and the wages general ledger account is credited. The credit side may also include employers' benefit contributions. Employers' benefit contributions are not deducted from employees' pay. They are extra costs paid by the employer. For example, if the employer must pay benefit contributions on behalf of employees, this increases the cost of employing staff. So the staff costs account is debited and the wages general ledger account is credited. The credit side may also include employers' pension contributions. Again, employers' pension contributions are not deducted from employees' wages. They are additional costs of the business. So they are treated as staff costs and credited to the wages general ledger account. The credit side may also include other staff costs. Other staff costs may be any other payroll-related cost that belongs to the employer. The important idea is that the credit side of the wages general ledger account shows the total payroll cost that must be cleared. Now let us move to the debit side of the wages general ledger account. The debit side shows where the payroll amount goes. The first item is bank net wages. Net wages are the amount actually paid to employees after deductions. Employees do not receive gross wages. They receive net wages. So when the employees are paid, the wages general ledger account is debited and the bank account is credited. Why? Because the wages general ledger account is being cleared and money is leaving the bank. The second item is income tax liability. Income tax is deducted from employees' gross pay. This amount is not paid to the employees. It is owed to the tax authority. So the wages general ledger account is debited and the income tax liability account is credited. The third item is benefit contributions liability for employees. This is the benefit contribution deducted from employees' wages. It reduces the employee's net pay, but it does not belong to the business. It must be paid later to the relevant authority. So the wages general ledger account is debited and the benefit contributions liability account is credited. The fourth item is benefit contributions liability for employers. This is the employer's own benefit contribution. It is an extra cost of the business, and it is also owed to the relevant authority. So after recording it as a staff cost, the amount is cleared from the wages general ledger account to the benefit contributions liability account. The fifth item is pension fund liability for employees. This is the pension contribution deducted from employees' wages. It is not paid to employees. It must be paid to the pension fund. So the wages general ledger account is debited and the pension fund liability account is credited. The sixth item is pension fund liability for employers. This is the employer's own pension contribution. It is an additional payroll cost to the business and must be paid to the pension fund. So the amount is cleared from the wages general ledger account to the pension fund liability account. The debit side may also include other deductions liability accounts. These are other amounts deducted from employees' pay and owed to another party. For example, there may be loan repayments, union deductions, season ticket loan repayments, or other authorized deductions. These amounts are not paid to the employee as net pay. They are recorded as liabilities until paid to the correct organization or account. Now, students, let us understand the full structure in simple words. The credit side tells us what the business has recorded as payroll cost. The debit side tells us where that payroll cost has gone. Some of it goes to employees through the bank as net wages. Some of it goes to tax authorities as income tax. Some of it goes to benefit contribution authorities. Some of it goes to pension funds. Some of it goes to other liability accounts. When everything has been recorded correctly, the total debit side should match the total credit side. This means the wages general ledger account should balance to nil. Now let's use a very simple example to understand the logic. Imagine a business records gross wages of $1,000. The employee deductions are income tax of $100 and pension contribution of $50. The net wages paid to employees are $850. The credit side of the wages general ledger account records gross wages of $1,000. The debit side clears that $1,000 like this. $850 goes to bank as net wages paid. $100 goes to income tax liability. $50 goes to pension fund liability. The debit side totals $1,000. The credit side also totals $1,000. So the wages general ledger account clears to nil. That is the main purpose of this account. Now let us add employer contributions to make it clearer. Suppose the employer also contributes $100 to a pension fund. This is not deducted from the employee. It is an extra cost to the business. So staff costs increase by $100, and the wages general ledger account is credited by $100. Then the wages general ledger account is debited, and the pension fund liability account is credited by $100. This means the employer contribution is recorded as a cost and also as an amount owed to the pension fund. Again, the wages general ledger account clears properly. Now, students, this lesson also gives us an important wording point. Strictly speaking, wages are normally paid weekly and salaries are normally paid monthly. Because of this, the wages general ledger account may also be called the wages and salaries general ledger account. Do not be confused by the name. In the exam, whether it is called the wages general ledger account or the wages and salaries general ledger account, the purpose is the same. It is used to record payroll entries and check that they are being posted correctly. Now here is the key exam understanding. The wages general ledger account is not just for recording the amount paid to employees. It also records deductions and employer contributions. Gross wages and employer contributions are entered through staff costs. Net pay is cleared to the bank account. Income tax deductions are cleared to income tax liability. Benefit contributions are cleared to benefit contributions liability. Pension contributions are cleared to pension fund liability. Other deductions are cleared to the correct liability accounts. After all entries are posted, the account should normally have a nil balance. So the big message of Lesson 7.3 is this. The Proforma Wages General Ledger account is a standard layout that shows how payroll costs, net wages, deductions, employer contributions, and liabilities are organized. It helps the accountant check that every part of payroll has been recorded correctly and that the wages general ledger account clears to nil at the end. Let us explain the question from Lesson 7.3, together with its answer. This question is about payroll double entry and the wages general ledger account. The company is Aroma. Aroma has payroll details for month 1. The question asks us to do two things. First, write the double entry for the payroll transactions. Second, show the wages general ledger account after all the transactions have been posted. Let us go step by step. First, we must understand what the wages general ledger account does. The wages general ledger account is used as a clearing account. This means payroll amounts enter the account, and then they are cleared out to the correct accounts. At the end, if everything is recorded correctly, the wages general ledger account should have no remaining balance. Now let us look at the information given. The gross wages and salaries are split between 3 departments. Administrative staff gross wages are $102,531. Sales and marketing staff gross wages are $226,704. Production staff gross wages are $1,067,895. These 3 amounts are all wages expenses, so they are debited to the correct wages expense accounts. Now let us add them together. $102,531 plus $226,704 plus $1,067,895 gives $1,397,130. So the first double entry is debit gross wages expense, administrative staff, $102,531. Debit gross wages expense, sales and marketing staff, $226,704. Debit gross wages expense, production staff, $1,067,895. Credit wages, general ledger account, $1,397,130. Why do we debit the gross wages expense accounts? Because wages are a cost to the business. Why do we credit the wages general ledger account? Because the wages general ledger account is collecting the payroll cost before it is cleared to bank and liability accounts. Now we record the employer's benefit contributions. Employer's benefit contributions are $104,782. This is not deducted from employees' pay. It is an extra cost of the business. So the entry is debit employer's benefit contributions expense, $104,782. Credit wages general ledger account, $104,782. Now, we record the employer's pension contributions. Employer's pension contributions are $41,728. Again, this is not deducted from employees' pay. It is an extra cost to the business. So the entry is debit employer's pension contributions expense, $41,728. Credit wages general ledger account, $41,728. Now let us record the pension fund payable. The pension fund payable includes two parts. The employer's pension contribution is $41,728. The employee's pension deduction is $37,860. Together, the pension fund payable is $79,588. This amount is owed to the pension fund. So the entry is debit wages general ledger account, $79,588. Credit pension fund, payable, $79,588. Why do we credit pension fund payable? Because the business owes this amount to the pension fund. Why do we debit the wages general ledger account? Because we are clearing this amount out of the wages general ledger account. Now we record the income tax and benefit contributions payable. This payable includes three parts. Income tax deductions are $351,826. Employer's benefit contributions are $104,782. Employees' benefit contributions are $83,829. Together, these make $540,437. So the entry is debit wages general ledger account, $540,437. Credit income tax and benefit contributions payable, $540,437. This amount is owed to the tax authority or benefit contribution authority. Now we record the net wages and salaries paid to employees. Net wages and salaries are $903,893. This is the amount actually paid to employees after deductions. When employees are paid, the bank account decreases. So the entry is debit wages general ledger account, $903,893. Credit bank, $903,893. Now we record the season ticket loan repayments. Season ticket loan repayments are $19,722. This means employees are repaying loans that the employer had previously given to them. The season ticket loan is an asset of the business because employees owe money back to the business. When employees repay the loan through payroll deductions, the asset is reduced. So the entry is debit wages general ledger account, $19,722. Credit season ticket loans asset account, $19,722. Now let us build the wages general ledger account. On the credit side, we record the payroll costs coming into the wages general ledger account. Gross wages expense is $1,397,130. Employer's benefit contributions expense is $104,782. Employer's pension contributions expense is $41,728. The total credit side is $1,543,640. Now, on the debit side, we record where the payroll has been cleared. Income tax and benefit contributions payable is $540,437. Pension fund payable is $79,588. Bank is $903,893. Season ticket loans is $19,722. The total debit side is also $1,543,640. So the wages general ledger account balances. The debit side and credit side are equal. There is no balance left. This is exactly what we expect. The wages general ledger account should clear to nil after all payroll entries have been posted. Now, students, let us understand the full logic. The total payroll cost to the business is not only the gross wages. The business also has employer benefit contributions and employer pension contributions. So total payroll cost is gross wages of $1,397,130, employer benefit contributions of $104,782, employer pension contributions of $41,728. Together, the total payroll cost is $1,543,640. Now, this total cost is cleared in different ways. Some of it is paid to employees as net wages. Some of it is owed to the tax and benefit authorities. Some of it is owed to the pension fund. Some of it reduces the season ticket loan asset because employees are repaying loans. That's why the wages general ledger account has several debit entries. Now, here is the key exam technique. When you see a payroll double entry question, separate the figures into groups. Gross wages go to wages expense accounts. Employer contributions go to expense accounts. Net wages go to bank. Income tax and benefit contributions go to liability accounts. Pension deductions and employer pension contributions go to pension fund payable. Loan repayments go to reduce the loan asset. Then use the wages general ledger account as the clearing account. If all entries are correct, the wages general ledger account will balance to nil. So the final message is this. This question is testing whether you understand that payroll is not just one payment. Payroll creates expenses, liabilities, bank payments, and deductions. The wages general ledger account brings everything together and proves that the payroll entries have been posted correctly. Well done, students. This is the end of Chapter 17, Recording Payroll Transactions. And this is not only the end of Chapter 17, this is the end of the full FIA FA1 book. Congratulations. You have completed all 17 chapters of FIA FA1, Recording Financial Transactions. That is a very big achievement. You started from the basic foundations of accounting. You learned step by step how business transactions are recorded, how documents are used, how ledger accounts work, how sales and purchases are recorded, how receivables and payables are controlled, how reconciliations are prepared, and now, in the final chapter, how payroll transactions are calculated and recorded. You should be proud of yourself, because completing a full accounting book is not a small thing. It requires patience, discipline, practice, and focus. Now let us quickly revise what we learned in Chapter 17. First, we learned about the nature of payroll. Payroll is the system used by a business to calculate and record payments to employees. We learned that payroll is important because employees must be paid correctly and on time. We also learned that the employer may have legal responsibilities to deduct tax and other contributions from employees' pay and pay them to the correct authority. So payroll is not only about paying workers. Payroll connects the employee, the employer, and the government. Second, we learned about gross pay and basic pay. Basic pay is the normal pay for the job. Gross pay is the total amount earned before deductions. Net pay is the amount actually received after deductions. We learned that gross pay may include basic pay, overtime, commission, bonuses, back pay, and other earnings. The simple idea is this. The employee earns gross pay. The employer deducts tax and other deductions. The employee receives net pay. Third, we learned different ways of calculating basic pay. Some employees are paid a fixed rate per period, such as a fixed monthly salary. Some employees are paid by hourly rate, where pay depends on hours worked. Some employees are paid by piecework, where pay depends on the number of units produced. We also learned that piecework may include a guaranteed minimum wage, and sometimes piecework hours are used when different products take different amounts of time to produce. Fourth, we learned about overtime, bonuses, and commission. Overtime is extra pay for hours worked above normal working hours. A bonus is an extra payment made as a reward for results achieved. Commission is extra pay based on sales or value generated by the employee. These items are added to gross pay before deductions are calculated. The important exam point is to read the question carefully because overtime, bonus, and commission may each have different rules and timing. Fifth, we learned about payroll administration and documentation. Payroll needs proper records. Timesheets record hours worked. Attendance records show attendance, absence, sickness, holidays, and leave. Personnel records show employee details, salary rates, job history, training, and leaving information. We also learned that the personnel department gives important information to payroll, such as salary changes, pay rates, start dates, and leaving dates. A good payroll system must be supported by proper documents. Without documents, payroll cannot be checked properly. Sixth, we learned about documentation for hourly paid employees and salaried staff. Hourly paid employees need attendance records, timesheets, job cards, and route cards because their pay may depend on hours worked or work completed. Salaried staff may also complete timesheets even if their salary is fixed. Why? Because timesheets can help the business measure product cost, calculate profitability, bill clients, and support overtime claims. So timesheets are not only for wage calculation, they are also useful for management control. Seventh, we learned about payroll deductions. Payroll deductions are amounts taken away from gross pay before the employee receives net pay. We studied income tax, benefit contributions, pension contributions, and other deductions. We learned an important difference. Employee contributions are deducted from the employee's gross pay. Employer contributions are extra costs paid by the business. This difference is very important for accounting entries and exam questions. Eighth, we learned about payment methods. Employees may be paid by cash, check, or bank transfer. Cash payments are less common because they create security problems and take more time and effort. Check payments reduce the need to handle cash, but they still need strong control. Bank transfer is now very common because it is faster, safer, and more efficient. But whatever payment method is used, payroll payments must be accurate, on time, secure, authorized, and properly recorded. Ninth, we learned about payslips. A payslip is very important because it explains the employee's pay. It shows gross pay, deductions, and net pay. Employees have the right to understand how their pay has been calculated. A payslip provides that evidence. 10th, we learned about updating records. Payroll does not finish when employees are paid. After payment, employee records, payroll records, and accounting records must be updated. The business must record gross pay, deductions, net pay, employer contributions, pension contributions, tax liabilities, and bank payments. These records must be accurate and up to date. Finally, we learned about payroll ledger accounts. We studied the wages general ledger account. The wages general ledger account is used as a clearing account for payroll. Gross wages and employer contributions enter the account. Net pay, tax deductions, benefit contributions, pension contributions, and other deductions are cleared out of the account. After all payroll entries are posted correctly, the wages general ledger account should have a nil balance. That means the payroll entries have been recorded and cleared properly. So students, the big message of Chapter 17 is this. Payroll is not only about paying employees. Payroll is a complete accounting process. It includes calculating gross pay, deducting tax and contributions, calculating net pay, preparing pay slips, paying employees, updating records, recording liabilities, and posting entries into the general ledger. Payroll must be accurate. Payroll must be timely. Payroll must be secure. Payroll must be authorized. Payroll must be properly documented. And now, students, with this chapter complete, you have completed the full FIA FA1 book. This is a proud moment. You have finished recording financial transactions from Chapter 1 to Chapter 17. You now have a strong foundation in basic accounting records, business documents, ledgers, control accounts, reconciliations, internal controls, and payroll. This foundation will help you in your next accounting studies. Very soon, we will start FIA MA1 and FIA FA2. FIA MA1 will help you understand management information and basic management accounting. FIA FA2 will take your financial accounting knowledge to the next level. So do not stop here. Stay with us. Keep learning step by step. If these lessons helped you, please like our videos, share them with your friends, and help other students learn accounting in a simple and clear way.